McGraw-Hill Audio presents How to Make Money in Stocks, a Winning System in Good Times or Bad, 3rd edition. Written by William J. O'Neill. Read by Chris Ryan. Introduction. Learning from the Greatest Winners. In the following chapters, I will show you exactly how to pick big winners in the stock market and nail down the profits in them, as well as how to substantially reduce your losses and mistakes. Many people who dabble in stocks either have mediocre results or lose money because of their lack of knowledge. But no one has to lose money. You can definitely learn to invest wisely. This book will provide you with the investment understanding, skills, and methods you need to become a more successful investor. I believe that most people in this country, and many others throughout the free world, young and old, regardless of profession, education, background, or economic position, positively should own common stock. This book isn't written for the elite, but for the millions of guys and gals everywhere who want a chance to be better off financially. You are never too old or too young to start investing. You can start small. If you're a typical working person or a beginning investor, it doesn't take a lot of money to start. You can begin with as little as $500 to $1,000 and add to it as you earn and save more money. I began with the purchase of just 5 shares of Procter & Gamble when I was only 21 and fresh out of school. You live in a fantastic time of unlimited opportunity, an era of outstanding new ideas, emerging industries, and new frontiers. The opportunities are out there for everyone. You are now in a continually changing new America. We lead the world in high technology, the internet, medical advancements, computer software, military capability, and innovative new entrepreneurial companies. The communist socialist system and concept of a command economy is now relegated to the ash heap of history. Our system of freedom and opportunity serves as a model of success for most countries in the world. It is not enough today for you to just work and earn a salary, to do the things you want to do, to go the places you want to go, to have the things you want to have in your life. You absolutely must save and invest intelligently. The second income from your investments and the net profits you can make will let you reach your goals and provide real security. This book will just change your whole life. Secret tip. The first step in learning to pick big stock market winners is for you to examine leading big winners of the past to learn all the characteristics of the most successful stocks. You will learn from this observation what type of price patterns these stocks developed just before their spectacular price advances. Other key factors you will discover include what the quarterly earnings of these companies were at the time, what the annual earnings histories of these organizations had been in the prior 3 years, what amount of trading volume was present, what degree of relative price strength occurred in the price of the stocks before their enormous success, and how many shares of common stock were outstanding in the capitalization of each company. You'll also learn that many of the greatest winners had significant new products or new management, and that many were tied to strong industry group moves caused by important changes occurring in an entire industry. It's easy to conduct this type of practical, common-sense analysis of all past successful leaders. I have already completed such a comprehensive study. In our historical analysis, we selected the greatest winning stocks in the stock market each year, in terms of percentage increase for the year, spanning the past half-century. We call the study the Model Book of Greatest Stock Market Winners. It covers the period from the 1950s through 2000, and analyzes in detail over 600 of the biggest winning companies in recent stock market history. Superstocks such as Texas Instruments, whose price soared from $25 to $250 from January 1958 through May 1960. Xerox, which escalated from $160 to the equivalent of $1,340 from March 1963 to June 1966. Syntex, which leaped from $100 to $570 in only 6 months during the last half of 1963. Dome Petroleum and Prime Computer, which respectively advanced 1,000% and 1,595% in the 1978 to 1980 stock market. Limited Stores, which wildly excited lucky share owners with a 3,500% increase between 1982 and 1987. And Cisco Systems, which advanced from a split-adjusted 10 cents to $82 between October 1990 and March 2000. Home Depot and Microsoft both increased more than 20 times during the 1980s and early 1990s. Home Depot is one of the all-time great performers, jumping 20-fold in less than 2 years from its initial public offering in September 1981, and then climbing another 10 times from 1988 to 1992. All of these companies offered exciting new products and concepts. Would you like to know the common characteristics and rules of success we discovered from this intensive study of all past stock market leaders? It's all covered in the next few chapters, and in a simple, easy-to-remember formula we have named CAN-SLIM. Each letter in the words CAN-SLIM stands for one of the 7 chief characteristics of these greatest winning stocks at their early developing stages, just before they made huge profits for their shareholders. Write the formula down and repeat it several times so you won't forget it. The reason CAN-SLIM continues to work, cycle after cycle, is because it is based solely on the reality of how the stock market actually works, rather than our personal opinion, or anyone else's, including Wall Street's. Further, human nature at work in the market simply doesn't change. So CAN-SLIM does not get outmoded as fads, fashions, and economic cycles come and go. It will beat big egos and personal opinions every time. You can definitely learn how to pick big winners in the stock market, and you can become part owner in the best companies in the world. So let's get started right now. Here's a sneak preview of CAN-SLIM. C. Current quarterly earnings per share. The higher the better. A. Annual earnings increases. Look for significant growth. N. New products, new management, new highs. Buying at the right time. S. Supply and demand. Shares outstanding plus big volume demand. L. Leader or laggard. Which is your stock? I. Institutional sponsorship. Follow the leaders. M. Market direction. How to determine it. Please begin immediately with Chapter 1. Go for it. You can do it. Chapter 1. C equals current quarterly earnings per share. The higher the better. Dell Computer, America Online, Cisco Systems. Why, among the thousands of stocks that trade each day, did these 3 perform so well during the 1990s? And what traits, among the hundreds that can move stocks up and down, did they all have in common? These are not idle questions. The answers unlock the secret to true success in the stock market. Our study of all the stock market superstars from the past half-century found they did indeed share common characteristics. However, none stood out as boldly as the profits each big winner reported in the latest quarter or two before its major price advance. In fact, if you look down a list of the market's biggest winners, you'll instantly see the relationship between booming profits and booming stocks. And you'll see why our studies have concluded that the stocks you select should show a major percentage increase in current quarterly earnings per share, the most recently reported quarter, when compared to the prior year's same quarter. Seek stocks showing huge current earnings increases. In our models of the 600 best-performing stocks from 1952 to 2001, 3 out of 4 showed earnings increases averaging more than 70% in the latest publicly reported quarter before they began their major advances. The remaining 25% that did not show solid current quarterly earnings increases did so the very next quarter and had an average earnings increase of 90%. If the best stocks had profit increases of this magnitude before they advanced rapidly in price, why should you settle for anything less? You may find that only 2% of all stocks listed on the NASDAQ or the New York Stock Exchange will show earnings gains of this size. But remember, you're looking for stocks that are exceptional, not lackluster. Don't worry, they're out there. However, as with any search, there can be traps and pitfalls along the way, and you need to know how to avoid them. The earnings per share, EPS number, you want to focus on is calculated by dividing a company's total after-tax profits by the number of common shares outstanding. This percentage change in EPS is the single most important element in stock selection today. The greater the percentage increase, the better. And yet, during the internet boom of the late 1990s, some people bought stocks based on big stories of profits and riches to come, while most internet and .com companies had only shown deficits to date. Given that companies like AOL and Yahoo were actually showing earnings, risking your hard-earned money in other unproven stocks was simply not necessary. AOL and Yahoo were the real leaders at that time. When the inevitable market correction, downturn, hit, lower-grade, more speculative companies with no earnings rapidly suffered the largest declines. You don't need that added risk. I'm continually amazed at how some professional money managers, let alone individual investors, buy common stocks with the current reported quarter's earnings flat, no change, or down. There is absolutely no good reason for a stock to go anywhere in a big, sustainable way if current earnings are poor. Even profit gains of 5% to 10% are insufficient to fuel a major price movement in a stock. It's also more likely for a company showing a mere increase of 8 or 10% to suddenly report lower earnings the next quarter. Unlike some institutional investors, who may be restricted by the size of their funds, individual investors have the luxury of investing in only the very best stocks in each bull cycle. While some of these stocks with no earnings, like Amazon.com and Priceline.com, had big moves in 1998 to 1999, most investors were better off buying stocks like America Online and Charles Schwab that had strong earnings. Following the CAN-SLIM strategy's emphasis on earnings ensures an investor will always be led to the strongest stocks in any market cycle, regardless of any temporary, highly speculative bubbles or euphoria. But remember, don't buy on earnings growth alone. We'll cover the other key factors in the chapters that follow. The key question for the winning investor must always be, how much are the current quarter's earnings per share up, in percentage terms, from the same quarter the year before? Let's say your company discloses that sales climbed 10% and net income advanced 12%. Sounds good, right? Not necessarily. You shouldn't be concerned with the company's total net income. You don't own the whole organization, you own shares in it. The company might have issued additional shares or diluted the common stock in other ways. So while net income may be up 12%, earnings per share, your main focus as an investor, may have inched up only 5% or 6%. You must be able to see through slanted presentations. Don't let their use of words like sales and net income divert your attention from the truly vital facts like current quarterly earnings. To further clarify this point, you should always compare a company's earnings per share to the same quarter a year earlier, not to the prior quarter, to avoid any distortion due to seasonality. In other words, you don't compare the December quarter's earnings to the prior September quarter's earnings per share. Rather, compare the December quarter of this year to the December quarter of last year for a more accurate evaluation. The winning investor should avoid the trap of being influenced by non-recurring profits. If a computer maker reports earnings for the last quarter that include non-recurring profits from activities such as the sale of real estate, this portion of earnings should be subtracted from the report. Such earnings represent a one-time, non-recurring event, and not the true, ongoing profitability of corporate operations. Ignore the earnings that result from these types of events. Whether you're a new or experienced investor, I would advise against buying any stock that doesn't show earnings per share up at least 18% or 20% in the most recent quarter versus the same quarter the year before. In our study of the greatest winning companies, we found that they all had this in common prior to their big price moves. Many successful investors use 25% or 30% as their minimum earnings parameter. To be even safer, insist that both of the last 2 quarters show significant earnings gains. During bull markets, major market uptrends, I prefer to concentrate on stocks that show powerful earnings gains, from 40% to 500% or more. You have thousands of stocks to choose from. Why not buy the very best merchandise available? To further sharpen your stock selection process, look ahead to the next quarter or two and check the earnings that were reported for those same quarters the previous year. See if the company will be coming up against unusually large or small earnings achieved a year ago. When the unusual year-earlier results are not due to seasonal factors, this step may help you anticipate a strong or poor earnings report in the coming months. Also, be sure to check consensus earnings estimates, projections that combine the earnings estimates of a large group of analysts, for the next several quarters, as well as the next year or two, to make sure the company is projected to be on a positive track. Some earnings estimate services even show an estimated annual earnings growth rate for the next 5 years for many companies. Many individuals and even some institutional investors, mutual funds, banks, and insurance companies, buy stocks with earnings down in the most recently reported quarter just because they like a company and think its stock price is cheap. Usually they accept the story that earnings will rebound strongly in the near future. In some cases this may be true, but in many cases it isn't. The point is, you have the choice of investing in thousands of companies, many of which are actually showing strong operating results. You don't have to accept promises of earnings that may never occur. It has been suggested in past years that Japanese firms concentrate more on long-term profits than current earnings per share. They spend money on projects that will strengthen the company's future, such as research and development. Their concept is sound, and one that better managed organizations in the United States, a minority of companies, also follow. It's how leading companies create colossal earnings increases. They spend years on the research and development of superior new products. But don't be confused. As an individual investor, you can afford to wait until the company proves its efforts have been successful by showing real earnings improvement. Requiring that current quarterly earnings be up a hefty amount is just another smart way the intelligent investor can reduce the risk of mistakes in stock selection. Many older American corporations have mediocre management that continually produces second-rate earnings results. I call them the entrenched maintainers, or caretaker management. These are the companies you want to avoid until someone has the courage to change top management. Not coincidentally, they are generally the companies that strain to pump up their current earnings a dull 8% or 10%. True growth companies with outstanding new products or improved management do not have to maximize current results. Our analysis of the most successful stocks also showed that, in almost every case, earnings growth accelerated sometime in the 10 quarters before a towering price move began. In other words, it's not just increased earnings that cause a big move, it's also the size of the increase plus the improvement from the company's prior percentage rate of earnings growth. Wall Street now calls many of these earnings surprises. If a company's earnings are up 15% a year and suddenly begin spurting 40% to 50% or more, it usually creates the conditions for important stock price improvement. Strong, improved quarterly earnings should always be supported by sales growth of at least 25% for the latest quarter, or at least an acceleration in the rate of sales percentage improvement over the last 3 quarters. Many newer issues, initial public offerings, may show the last 8, 10, or 12 quarters of huge sales increases, sometimes averaging 100% or more. Some professional investors bought Waste Management at $50 in early 1998 because earnings had jumped 3 quarters in a row, from 24% to 75% and 268%. However, sales were only up 5%. Several months later, the stock collapsed to $15 a share. What this demonstrates is that earnings can be inflated for a few quarters by cost reduction or reducing R&D, depreciation, reserves, advertising, or other constructive activities. However, to be sustainable, earnings growth must be supported by sales increases. Such was not the case with Waste Management. It also helps improve your batting average if your stock selections show the latest quarter's after-tax profit margins are either at or near a new high. Just as it's important to recognize when quarterly earnings growth is accelerating, it's also important to know when earnings begin to decelerate and significantly slow down. By this I mean if a company growing at a 50% rate suddenly reports earnings gains of only 15%. That usually spells trouble, and you probably want to avoid it. When this happens, the stock frequently has either topped out permanently, regardless of what Wall Street analysts say, or its rate of upward progress will flatten into a lengthy and unrewarding period of price consolidation, sideways price movement, without further price progress up. However, before turning negative on a company's earnings, I prefer to see 2 quarters of material slowdown, usually a 2/3 decline from the prior several quarters' rate of growth. Even the best organizations can have 1 slow quarter every once in a while. Understanding the principle of earnings acceleration or deceleration is essential. Securities analysts who recommend stocks because of an absolute level of earnings expected for the following year could be looking at the wrong set of facts. A stock that earned $5 per share and expects to report $6 the next year, a favorable 20% increase, could mislead you unless you know the previous trend in the percentage rate of earnings change. What if previously it was up 60%? This partially explains why so few investors make significant money following the buy and sell recommendations of securities analysts. Logarithmic scale graphs are of great value in analyzing stocks because acceleration or deceleration in the percentage rate of quarterly earnings increases can be seen very clearly. Log graphs show percentage changes accurately, since 1 inch anywhere on the price or earnings scale represents the same percentage change. This is not true of arithmetically scaled charts. For example, on an arithmetically scaled chart, a 100% price increase from $10 to $20 a share would show the same space change as a 50% increase from $20 to $30 a share. In contrast, a logarithmic graph would show the 100% increase as twice as large as the 50% increase. You, as a do-it-yourself investor, can take the latest quarterly earnings per share, EPS, along with the prior 3 quarters EPS, and plot them on a logarithmic scale graph to get a clear picture of earnings acceleration or deceleration. The plotting of the most recent 12-month earnings each quarter should, in the best companies, put the earnings per share point close to or already at new highs. For additional validation, check the earnings of other companies in your stock's industry group. If you can't find 1 or 2 other impressive stocks in the group displaying strong earnings, chances are you may have selected the wrong investment. Where to find current quarterly earnings reports? Quarterly corporate earnings statements are published every day in the business sections of most local newspapers and financial publications. Investors Business Daily goes 1 step further and separates all new earnings reports into companies with up earnings from those reporting down results, so you can easily see who produced excellent gains and who didn't. Chart services like Daily Graphs Online, and others also show earnings reported during the week as well as the most recent earnings figures for every stock they chart. Once you locate the percentage change in earnings per share when compared to the same year-ago quarter, also compare the percentage change in EPS on a quarter-by-quarter basis. Looking at the March quarter and then at the June, September, and December quarters will tell you if a company's earnings growth is accelerating or decelerating. You now have the first critical rule for improving your stock selection. Current quarterly earnings per share should be up a major percentage, at least 25% to 50% or more, over the same quarter the previous year. The best companies might show earnings up 100% to 500% or more. A mediocre 10% or 12% isn't enough. When picking winning stocks, it's the bottom line that counts. Chapter 2. A equals annual earnings increases. Look for significant growth. Any company can report a good earnings quarter every once in a while, and as we've seen, strong current quarterly earnings are critical to picking most of the market's biggest winners. But it's not enough. To ensure that the latest results aren't just a flash in the pan, and that the company you are looking at is a quality one, you must insist on more proof. The way to do that is by reviewing the company's annual earnings growth rate. Look for annual earnings per share that have increased every year for the last 3 years. You normally don't want the second year's earnings down, even if the following year rebounds and is in new high ground. It is the combination of strong earnings in the last few quarters plus a record of solid growth in recent years that creates a superb stock, or at least one with a higher probability for success. Select stocks with 25% to 50% or more annual growth rates. The annual rate of earnings growth in the companies you pick should be 25%, 50%, even 100% or more. Between 1980 and 2000, the median annual growth rate of all outstanding stocks in our study at their early emerging stage was 36%. 3 out of 4 of the biggest winners showed at least some positive annual growth rate over the 5 years preceding the stock's big run-up. A typical earnings per share progression for the 5 years preceding the stock's move might be something like 70 cents, $1.15, $1.85, $2.65, and $4. In a few cases, you might accept one down year in the last 5, as long as the following year's earnings quickly recover and move back to new high ground. It's possible that a company could earn $4 a share one year, $5 the next, $6 the next, and then $2 a share. If the next annual earnings statement was, say, $2.50 per share versus the prior year's $2, it would still not be a good report, despite the 25% increase. The only reason it seems attractive is that the previous $2 a share year was so depressed that any improvement would look good. The point is, profits are recovering slowly and are still well below the company's annual peak earnings of $6 a share. The consensus earnings estimate for the next year should also be up. The greater the increase, the better. Remember, however, that estimates are opinions, and opinions may be wrong. Actual reported earnings are facts. Also, you should not ignore a company's annual return on equity, ROE. Our studies show that the greatest winning stocks of the past 50 years had ROEs of at least 17%. Return on equity helps separate the well-managed companies from the poorly managed ones. Additionally, look for growth stocks showing annual cash flow per share greater than actual earnings per share by at least 20%. Through our research, we've developed an additional factor that has proved to be important in selecting growth stocks: the stability and consistency of annual earnings growth over the past 3 years. Our stability measurement, which is expressed on a scale from 1 to 99, is calculated differently than most statistics. The lower the figure, the more stable the past earnings record. The figures are calculated by plotting quarterly earnings for the past 5 years and fitting a trend line around the plot points to determine the degree of deviation from the basic trend. Growth stocks with steady earnings tend to show a stability figure below 20 or 25. Companies with stability ratings over 30 are more cyclical and a little less dependable in terms of their growth. All other things being equal, you may want to look for stocks showing a greater degree of sustainability, consistency, and stability in past earnings growth. When the quarterly earnings are plotted on a log chart for several years, the earnings line should be on a nearly straight line, consistently moving up. Earnings stability numbers are usually shown immediately after a company's annual growth rate, although most analysts and investment services do not bother to make the calculation. We show them in many of our institutional products, as well as in Daily Graphs and Daily Graphs Online, designed for individual investors. If you restrict your stock selections to ventures with proven growth records, you avoid the hundreds of investments with erratic histories or cyclical recoveries in profits. Such stocks may top out as they approach the peaks of their prior earnings cycle. History demonstrates that most bull, up market cycles last 2 to 4 years and are followed by a recession or bear, down market. Then another bull market starts. In the beginning phase of a new bull market, growth stocks are usually the first to lead and make new price highs. Basic industry groups such as steel, chemical, paper, rubber, machinery, and other so-called cyclical stocks usually lag. Young growth stocks will usually dominate for at least 2 bull cycles. Then the emphasis may change for a short period to turnarounds, cyclicals, or other newly improved sectors. While 3 out of 4 big market winners in the past were growth stocks, 1 in 4 was a turnaround situation. In 1982, Chrysler and Ford were 2 such spirited turnaround plays. Cyclical and turnaround opportunities led in the market waves of 1953 to 1955, 1963 to 1965, and 1974 to 1975. Cyclicals like paper, aluminum, autos, chemicals, and plastics returned to the fore in 1987. Home building stocks, also cyclical, have led in other cycles. IBM was a great example of a turnaround situation in 1994. Yet even in these periods, there were some pretty dramatic young growth stocks available. Basic industry stocks in the United States often represent older, more inefficient industries, some of which are no longer internationally competitive and growing. They do not represent America's future. Rallies in cyclical stocks tend to be short-lived and prone to falter at the first hint of an earnings slowdown. Should you decide to buy strong turnaround stocks, the annual earnings growth rate could be 5% to 10%. Requiring a turnaround company to show 2 consecutive quarters of sharp earnings recovery should put the earnings for the latest 12 months into or very near new high ground. Look at the 12 months earnings line on a stock chart. The sharper the upswing, the better. If the profit upswing is so dramatic that it reaches a new high, sometimes 1 quarter of earnings turnaround will suffice. Using 3-year annual earnings per share growth criteria will help you weed out 80% of stocks in any industry group. Keep in mind that an annual growth record doesn't necessarily mean a company is a growth stock. In fact, many so-called growth stocks report substantially slower growth than they did in earlier market periods. A company with an outstanding 3-year growth record of 30%, but whose earnings in the last several quarters have slowed significantly to 10% and 15%, acts like a fully mature growth stock. Older and larger organizations often show slowed growth and in most cases should be avoided. From 1998 to 2000, McDonald's Corporation had a 3-year growth rate of only 10%, which is substandard in today's growth stock markets. A standout stock needs a sound growth record during recent years, but also a strong current earnings record in the last few quarters. It is the powerful combination of these 2 critical factors, rather than one or the other, which creates a super stock, or at least one that has a higher chance for true success. The fastest way to find a company with strong and accelerating current earnings and solid 3-year growth is by checking the earnings per share, EPS rating provided for every stock listed in Investor's Business Daily. The EPS rating is defined as a proprietary rating that measures a company's 2 most recent quarters' earnings growth rate compared to the same quarters 1 year prior. Then the company's 3-year annual growth rate is examined. The results are compared to all other publicly traded companies and rated on a scale from 1 to 99, with 99 being best. An EPS rating of 99 means that a company has outperformed 99% of all other companies in terms of both annual and recent quarterly earnings performance. If an initial public offering doesn't show a 3-year earnings record, look for the last 5 or 6 quarterly earnings reports to be up a huge amount, and even more quarters of enormous sales increases. 1 or 2 quarters of profitability is frequently not enough, and represents a less proven stock that might fall apart somewhere down the line. If you're like most investors, you've probably learned that the most important thing you need to know about a stock is its price-to-earnings, PE ratio. Well, prepare yourself for a bubble-bursting surprise. While PE ratios have been used for years by analysts as their basic measurement tool in deciding if a stock is undervalued, has a low PE, and should be bought, or is overvalued, has a high PE, and should be sold, our ongoing analysis of the most successful stocks from 1952 to present shows that PE ratios were not a relevant factor in price movement and have very little to do with whether a stock should be bought or sold. PEs are an end effect, not a cause. Much more crucial, we found, was the percentage increase in earnings per share. To say a security is undervalued because it's selling at a low PE or because it's in the low range of its historical PE is nonsense. Primary consideration should be given to whether the rate of change in earnings is substantially increasing or decreasing. From 1953 through 1985, the average PE ratio for the best-performing stocks at their early emerging stage was 20. The PE of the Dow Jones Industrial Average at the time averaged 15. While advancing, the biggest winners expanded their PEs by 125% to about 45. During the 1990 to 1995 period, the real leaders began with an average PE of 36 and expanded into the 80s. Since these are averages, the beginning PE range for most big winners was 25 to 50, and the PE expansions varied from 60 to 115. The late 1990s market euphoria saw these valuations increase to even greater levels. Value buyers missed all of these tremendous investments. While the above-mentioned numbers are just averages, they do strongly suggest that if you were not willing to pay an average of 25 to 50 times earnings, or even much more, for growth stocks, you automatically eliminated most of the best investments available. Thus, you would have missed out on Microsoft, Cisco Systems, Home Depot, and America Online during their periods of greatest market performance. High PEs were found to occur because of bull markets. Low PEs, with the exception of cyclical stocks, generally occurred because of bear markets. In a roaring bull market, don't overlook a stock just because its PE seems too high. It could be the next great stock market winner. Never buy a stock solely because the PE ratio makes it look like a bargain. There are usually good reasons why PEs are low, and there's no golden rule in the stock market that protects a stock that sells at 8 or 10 times earnings from going even lower and selling at 4 or 5 times earnings. Many years ago, when I first began to study the market, I bought Northrop at 4 times earnings and watched in disbelief as the stock declined to a PE ratio of 2. Many Wall Street analysts put a stock on their buy list because it's selling in the low end of its historical PE range. They'll also recommend a stock when the price starts to drop, thereby lowering the PE and making it seem like an even bigger bargain. In 1998, Gillette and Coca-Cola looked like great buys because they sold off several points and their PEs looked more attractive. In actuality, the earnings growth in both companies showed material deceleration, which justified a lower PE valuation. Much of this questionable method of PE analysis is based on personal opinions and theories handed down through the years by analysts, academicians, and others who often have questionable track records when it comes to making money in the market. Reliance on P/E ratios often ignores more basic trends. For example, the general market may have topped out, in which case all stocks are headed lower. It's ridiculous and somewhat naive to say a company is undervalued, because at one time it was 22 times earnings, and it can now be bought for 15 times earnings. Another faulty use of price-earning ratios, by amateurs and professionals alike, is to evaluate stocks in an industry and conclude that the one selling at the cheapest P/E is always undervalued, and therefore the most attractive purchase. The reality is that the lowest P/E usually belongs to the company with the most ghastly earnings record, and that's precisely why it sells at the lowest P/E. The simple truth is that stocks at any one time usually sell near their current value. The stock that sells at 20 times earnings is there for one set of market-determined reasons, and the stock that trades for 15 times earnings is there for another set of reasons. A stock selling at, say, 7 times earnings does so because its overall record is more deficient than a stock with a higher P/E ratio. Also keep in mind that cyclical stocks normally have lower P/Es. In good periods, they do not show the P/E expansion that happens in growth stocks. You can't buy a Mercedes for the price of a Chevrolet. Everything sells for about what it is worth at the time. If a company's price and P/E ratio change in the near future, it's because conditions, events, psychology, and earnings continue to improve, or suddenly start to deteriorate as the weeks and months pass. Eventually, a stock's P/E will reach a peak, but this normally occurs when the general market averages are topping out and starting a significant decline. It could also be a signal that the stock is about to lose its earnings momentum. It is true that high P/E stocks will be more volatile, particularly if they are in the volatile high-tech area. The price of a high P/E stock can also get temporarily ahead of itself, but the same can also be said for lower P/E stocks. Chapter 3. N equals new products, new management, new highs. Buying at the right time. It takes something new to produce a startling advance in the price of a stock. It can be an important new product or service that sells rapidly and causes earnings to accelerate above previous rates of increase. Or it can be a change of management that brings new vigor, new ideas, or at least a new broom to sweep everything clean. New industry conditions, shortages, price increases, or revolutionary technologies, for example, can affect most stocks in an industry group in a positive way. In our study of the greatest stock market winners from 1952 through 2001, we discovered that more than 95% of stunning successes in American industry met at least one of the above criteria. One of the ways a company can achieve enormous success, thereby enjoying large gains in its stock price, is by introducing new products into the marketplace. We're not talking about a new formula for dish soap. These products and companies have to revolutionize the way we live. There is another fascinating phenomenon we found in the early stage of all winning stocks. We call it the Great Paradox. The staggering majority of individual investors, whether new or experienced, take delightful comfort in buying stocks that are down substantially from their peaks, thinking they're getting a bargain. Among the hundreds of thousands of individual investors attending my investment lectures in the 1970s, 1980s, and 1990s, 98% said they do not buy stocks that are making new highs in price. This phenomenon is not limited to individual investors. I have provided extensive research for more than 600 major institutional investors and have found that many of them are also bottom buyers. They, too, feel it's safer to buy stocks that look like bargains because they're either down a lot in price or actually selling near their lows. Our study of the greatest stock market winners proved, surprisingly, that the old adage, buy low, sell high, was completely wrong. In fact, our study proved the exact opposite. The hard-to-believe great paradox in the stock market is, what seems too high in price and risky to the majority usually goes higher, and what seems low and cheap usually goes lower. Are you finding this high-altitude paradox a little difficult to act upon? Let me cite another study we conducted. In this one, we analyzed two groups of stocks over many market periods, those that made new highs and those that made new lows. The results were conclusive. Stocks on the new high list tended to go higher in price, while those on the new low list tended to go lower in price. Based on our research, a stock on IBD's new price low list tends to be a pretty poor prospect and should be avoided. In fact, decisive investors should sell such stocks long before they get on the new price low list. A stock making the new high list, especially for the first time while trading on big volume during a bull market, might be a prospect with big potential. Ask yourself, what does a stock that is traded between $40 and $50 a share over many months and is now selling at $50 have to do to double in price? Doesn't it first have to go through $51, then $52 and $53, $54, $55, and so on, all new price highs, before it can reach $100? As a smart investor, your job is to buy when a stock looks too high to the majority of conventional investors, and sell after it moves substantially higher and finally begins to look attractive to some of those same investors. If you bought Cisco at the highest price it ever sold for in 1990, when it just made a new high and looked scary, you would have enjoyed a nearly 75,000% increase from that point forward. Just because a stock is making a new price high does not necessarily mean it's the right time to buy. Using stock charts is an important piece of the stock selection process. A stock's historical price movement should be reviewed carefully, and you should look for stocks making new price highs as they break out of price consolidation areas, or bases. Why? Because this is the point where most really big price advances begin, and it is the time where the probability of a significant price move is the greatest. A sound consolidation or base building period could last from 7 or 8 weeks up to 15 months, so some bases are short and some are longer time-wise. The perfect time is during a bull market, just as a stock is starting to break out of its price base. This is what is referred to as the pivot or buy point. You should avoid buying once the stock is more than 5% or 10% above the exact buy point off the base. Otherwise, your chance of getting shaken out in the next correction or pullback in price greatly increases. Chapter 4. S equals supply and demand. Shares outstanding plus big volume demand. The law of supply and demand determines the price of almost everything in your daily life. At the grocery store, for instance, what you pay for your lettuce, tomatoes, eggs, and beef depends on how much of each item there is and how many people want these items. It impacted the price of food and consumer goods even in former communist countries. There, state-owned items were always in short supply and often available only to the privileged class or on the black market to those who could pay the exorbitant prices. This basic principle of supply and demand also applies to the stock market, where it is more important than all the analyst opinions on Wall Street. The price of a common stock with 5 billion shares outstanding is harder to budge because there's such a large supply. It takes a large volume of buying or demand to create a rousing price increase. On the other hand, if a company has only 50 million shares outstanding, a relatively small supply, just a reasonable amount of buying or demand can push the price up more rapidly. If you were choosing between two stocks to buy, one with 5 billion shares outstanding and the other with 50 million, the smaller one will usually be the better performer if other factors are equal. However, since smaller capitalization stocks are less liquid, they can come down as fast as they go up, sometimes even faster. In other words, with greater opportunity comes significant additional risk. The total number of shares outstanding in a company's capital structure represents the potential amount of stock available. But market professionals also look at the floating supply, the shares left for possible purchase after subtracting stock that is closely held. Companies in which top management owns a large percentage of the stock, at least 2% to 3% in a large company and more in small companies, generally are your better prospects because they have a vested interest in the stock. There's another fundamental reason, besides supply and demand, why companies with a large number of shares frequently produce slower results. The companies themselves may be much older, growing at a slower rate, and simply too big and sluggish. During the 1990s, a phenomenon occurred where for several years, big-cap stocks outperformed small-cap stocks. This was in part related to the size problem experienced by the mutual fund community that suddenly found itself awash in huge amounts of new cash as more and more people bought mutual funds. As a result, the industry was forced to buy bigger-cap stocks. It appeared that funds favored bigger-cap stocks because of the need to put more money to work. This was contrary to the normally favorable supply-demand effect found in smaller-cap stocks with fewer shares around to meet increases in investor demand. Big-cap stocks do have some advantages: greater liquidity, less downside volatility, better quality, and usually less risk. The immense buying power of large funds can make a top-notch big stock advance nearly as fast as shares of a smaller company. Great size may create seeming power and influence, but size in corporations can also produce a lack of imagination. Big companies are often run by older and more conservative caretaker management, less willing to innovate, take risks, and keep up with the times. In most cases, top managers of large companies don't own a lot of their company's stock. This is a serious defect that should be corrected, since it implies to the savvy investor that the company's management and employees don't have any personal interest in seeing the company succeed. Also, in some cases, multiple layers of management separate the senior executives from what's really going on at the customer level. And in a capitalist economy, the ultimate boss in a company is the customer. Times are changing at an ever faster rate. A company with a hot new product today will find sales slipping within 2 or 3 years if it doesn't continue to bring relevant new products to market. Most new products, services, and inventions come from young, hungry, innovative, small and medium-sized companies with entrepreneurial management. Not coincidentally, these organizations grow much faster and create most of the new jobs. Many are in the service or technology industries. This is where the great future growth of America lies. Microsoft, Cisco Systems, and Oracle are just a few examples of dynamic small-cap innovators of the 1980s and 1990s that continually grew and became big-cap stocks. In contrast, if a mammoth older company creates an important new product, it may not materially help its stock because the product will probably account for only a small percentage of the company's total sales and earnings. The product is simply a small drop in a bucket that's just too big. From time to time, companies make the mistake of excessively splitting their stocks. This is sometimes done on advice from Wall Street investment bankers. In my opinion, it's usually better for a company to split its shares 2 for 1 or 3 for 2 than 3 for 1 or 5 for 1. When a stock splits 2 for 1, you get 2 shares for each share previously held, but the new shares sell for half the price. Oversized splits create a substantially larger supply and may put a company in the more lethargic big cap status sooner. It may be unwise for a company whose stock has gone up in price for a year or two to declare an extravagant split near the end of a bull market or in the early stage of a bear market. Yet, this is exactly what many corporations do. Generally speaking, these companies feel the lower-priced stock will attract more buyers. This may be the case with some smaller buyers, but it also may produce the opposite result, more sellers, especially if it's the second split in the last year or two. Knowledgeable pros and a few shrewd individual traders will probably use the excitement generated by the oversized split as an opportunity to sell and take their profits. A stock will often top in price around the second or third time it splits. Our study of the biggest winners found only 18% of them had splits in the year preceding their great price advances. Large holders who are thinking of selling might figure it's easier to unload their 100,000 shares before a 3-for-1 split than sell 300,000 shares afterward. And smart short sellers pick on stocks that are heavily owned by institutions and starting to falter after huge price run-ups. In most, but not all cases, it's usually a good sign when a company, and especially a small to medium-sized growth company that meets the CAN-SLIM criteria, buys its own stock in the open marketplace over a consistent period of time. A 10% buyback would be considered big. This reduces the number of shares in the marketplace and usually implies the company expects improved sales and earnings in the future. As a result of the buyback, the company's net income will be divided by a smaller number of shares, thereby increasing earnings per share. As we've discussed, the percentage increase in earnings per share is one of the principal driving forces behind outstanding stocks. From the mid-1970s to the early 1980s, Tandy, Teledyne, and Metro Media successfully repurchased their own stock. All three produced notable results in their earnings per share growth and in the price advance of their stock. Tandy's split-adjusted stock increased from $2.75 to $60 between 1973 and 1983. Teledyne stock zoomed from $8 to $190 from 1971 to 1984. And Metro Media soared from $30 to $560 from 1971 to 1977. Teledyne shrank its capitalization from 88 million shares to 15 million and increased its earnings from 61 cents a share to nearly $20 per share with 8 separate buybacks. In 1989 and 1990, International Game Technology announced they were buying back 20% of their stock. By September 1993, IGT had advanced more than 20 times. NVR Incorporated had big buybacks in 2001. After you found a stock with a reasonable number of shares, check the percentage of the company's total capitalization represented by long-term debt or bonds. Usually, the lower the debt ratio, the safer and better the company. Earnings per share of companies with high debt-to-equity ratios could be clobbered in difficult periods of high interest rates. These highly leveraged companies are generally of lower quality and higher risk. A corporation that's been reducing its debt as a percent of equity over the last 2 or 3 years is worth considering. If nothing else, interest costs will be sharply reduced, helping generate higher earnings per share. Additionally, the presence of convertible bonds in the capital structure could dilute earnings if and when the bonds are converted into shares of common stock. The best way to measure a stock's supply and demand is by watching its daily trading volume. When a stock pulls back in price, you want to see volume dry up, indicating no significant selling pressure. When it rallies up in price, you want to see volume rise, which usually represents institutional buying. When a stock breaks out of a price consolidation area, trading volume should be at least 50% above normal. In many cases, it will increase 100% or more for the day, indicating solid buying of the stock and the possibility for further increases in price. Using daily and weekly charts helps you analyze and interpret a stock's price and volume action. Remember, any size capitalization stock can be bought under the CAN-SLIM method, but small-cap stocks will be substantially more volatile, both on the upside and the downside. From time to time, the market will shift its emphasis from small to large caps and vice versa. Companies buying back their stock in the open market and companies showing stock ownership by management are preferred. Chapter 5. L equals leader or laggard. Which is your stock? People tend to buy stocks they like, stocks they feel good about, or stocks they feel comfortable with. But in an otherwise exciting stock market, These sentimental securities often lag the market rather than lead it. Suppose you want to buy a stock in the computer industry. If you buy the leader in the group, and if your timing is right, you have a crack at real price appreciation. But if you buy a stock that hasn't yet moved, or is down the most in price because you feel safer with it and think you're getting a real bargain, you might have bought a stock with little upward price potential. Why else would it be at the bottom of the pile? Don't just dabble in stocks. Dig in, do some detective work, and find out what really works. The top 2 or 3 stocks in a strong industry group can have unbelievable growth, while others in the pack may hardly stir. In 1979 and 1980, Wang Labs, Prime Computer, DataPoint, Rohm Corporation, Tandy Corporation, and other small computer companies had 5-, 6-, and 7-fold advances before topping and retreating. Grand old IBM, on the other hand, just sat there, and giants Burroughs, NCR, and Sperry Rand turned in lifeless performances. However, in the next bull market cycle, IBM sprang to life and produced excellent results. Home Depot advanced 10 times from 1988 to 1992, while Wabin and Hechinger, the group's laggards, dramatically underperformed. You should buy the really great companies, the ones that lead their industries and are number one in their particular field. All of my best big winners, Syntex in 1963, Pick and Save from 1976 to 1983, Price Company from 1982 to 1985, Franklin Resources from 1985 to 1986, Genentech from 1986 to 1987, Amgen from 1990 to 1991, America Online from 1998 to 1999, Charles Schwab from 1998 to 1999, Sun Microsystems from 1998 to 1999, and Qualcomm in 1999 were the number one companies in their industries at the time they were purchased. The number one market leader is not the largest company or the one with the most recognized brand name. It's the one with the best quarterly and annual earnings growth, return on equity, profit margins, sales growth, and price action. It will also have a superior product or service and be gaining market share from its older, less innovative competitors. As our studies show, very little in the stock market is really new. History just keeps repeating itself. In the summer of 1963, I bought stock in Syntex, the developer of the birth control pill, which then shot up 400%. Most people wouldn't buy it because it had just made a new price high at $100, and its P/E ratio at 45 seemed too high. Instead, several investment firms recommended G.D. Searle as a sympathy play. It looked much cheaper in price and had a product similar to Syntex's, but it failed to produce the same market results. Syntex was the leader, Searle the laggard. A sympathy play is a stock in the same group as a leading company, and it's bought in the hope that the leader's luster will rub off onto it. But the profit and price records of sympathy plays usually pale in comparison. Eventually they'll try to move up in sympathy with the real leader, but they never do as well. In 1970, Levitz Furniture, the leader in the then-new warehouse business, became an electrifying market winner. Wix Corporation copied Levitz, and many people bought its shares because they were cheaper in price. But Wix never performed and ultimately got into financial trouble. Levitz, meanwhile, appreciated 900% before it finally topped. As steel industry pioneer Andrew Carnegie said in his autobiography, "The first man gets the oyster, the second the shell." If you own a portfolio of stocks, you must learn to sell the worst performers first and keep the best ones a little longer. In other words, always sell your losers and mistakes, and watch your better selections to see if they progress into your big winners. There's a fast and easy way to tell if your stock is a leader or a laggard. Check IBD's Relative Price Strength, RS rating. The RS rating is defined as a proprietary rating that measures the price performance of a given stock against the rest of the market for the past 52 weeks. Each stock is assigned a performance rating from 1 to 99, with 99 being best. An RS rating of 99 means the stock has outperformed 99% of all other companies in terms of price performance. If your stock's RS rating is below 70, it's lagging the better performing stocks in the overall market. That doesn't mean it can't go up in price. It just means that if by some chance it does go up, it'll probably go up less. The average RS rating of the best performing stocks each year from the early 1950s through 2000 was 87 before their major run-ups. So the determined winners rule: avoid laggard stocks and sympathy moves. Look for the genuine leaders. The relative price strength rating is shown each day for all New York Stock Exchange, NASDAQ, and Amex stocks listed in Investors Business Daily's stock tables. You can't find this information in any other newspaper. Updated RS ratings are also shown on the Daily Graphs Online charting service. In addition to IBD's proprietary RS rating, you'll also want to look on a chart for the relative strength line. If it has been sinking for 7 months or more, or if the line has an abnormally sharp decline for 4 months or more, the stock's price behavior is highly questionable. Want to upgrade your stock selection and concentrate on the best leaders? Restrict your purchases to companies showing a relative price strength rating of 80 or higher. There's no point to buying a stock that's straggling behind many others in the market, yet that's exactly what many investors do. Most do it without ever looking at a relative strength line or RS rating, including some of America's largest investment firms. I don't like to buy stocks with relative price strength ratings less than 80. In fact, the really big money-making selections generally have RS ratings of 90 or higher just before breaking out of their first or second base structure. The RS rating of a potential winning stock should be in the same league as a pitcher's fastball. The average big league fastball is clocked about 86 miles per hour, and the best pitchers throw heat in the 90s. When you buy, make absolutely sure the stock is coming out of a sound base, price consolidation area, and that you buy it at its exact pivot buy point. Also, be sure it's not extended more than 5% or 10% above the precise buy point of this base. This will keep you from chasing stocks that have raced up in price too rapidly above their bases. Buying stocks that are extended percentage-wise too far from a correct buy point will result in more sharp sell-offs in price that will shake you out of a stock. The unwillingness of investors to set and follow minimum standards for stock selection reminds me of doctors years ago who were ignorant of the need to sterilize their instruments before each operation. They kept killing off patients until surgeons finally and begrudgingly accepted studies by researchers Louis Pasteur and Joseph Lister. Ignorance rarely pays off in any walk of life, and it's no different in the stock market. Corrections, or price declines, in the general market can help you recognize new leaders if you know what to look for. The more desirable growth stocks normally correct 1.5 to 2.5 times the general market averages. In a bull market correction, growth stocks declining the least percentage-wise are usually your best selections. The stocks that drop the most are normally your weakest. Say the general market average suffers an intermediate-term correction of 10%, and 3 of your successful growth stocks come off 15%, 20%, and 30%. The 2 off only 15% or 20% are likely to be your best investments after they recover. A stock sliding 35% to 40% in a general market decline of 10% could be flashing a warning signal. In most cases, you should heed it. Once a general market decline is definitely over, the first stocks that bounce back to new price highs are almost always your authentic leaders. These breakouts continue week by week for about 3 months. Many professional investment managers make the serious mistake of buying stocks that have just suffered unusually large price drops. As our studies indicate, this is a surefire way to get yourself in trouble. In June 1972, a normally capable institutional investor in Maryland bought Levitt's Furniture after its first abnormal price break, a one-week drop from $60 to around $40. The stock rallied for a few weeks, rolled over, and broke to $18. In October 1978, several institutional investors bought Memorex when it had its first unusual price break. It later plunged. In September 1981, certain money managers in New York bought Dome Petroleum on a break from $16 to $12. To them, it seemed cheap, and there was a favorable story about the stock going around Wall Street. Months later, Dome sold for $1. Institutional buyers snapped up Lucent Technologies at the start of 2000 when it broke from $78 to $50. Later in the year, it collapsed to $5. None of these pros recognized the difference between normal price declines and highly abnormal, big-volume corrections that signal potential disaster. The real problem, of course, was these experts all relied solely on fundamental analysis and stories, and their personal opinion of value, lower P/E ratios. They didn't pay attention to the market action that could have told them what was really going on. Those who ignore what the market says usually pay a heavy price. Those who listen and who learn the difference between normal and abnormal action are said to have a good feel for the market. In the spring of 1967, I remember walking through a broker's office in New York on a day when the Dow Jones Industrial Average was down over 12 points. 12 points was a lot in those days. When I looked up at the electronic ticker tape showing prices moving across the wall, I saw that Control Data was trading at $62, up 3.5 points on heavy volume. I bought the stock at once. I knew Control Data well, and this was abnormal strength in the face of a weak overall market. The stock later ran up to $150. In April 1981, just as the 1981 bear market was getting underway, MCI Communications, a Washington, D.C.-based telecommunications stock trading in the over-the-counter market, broke out of a price base at $15. It advanced to the equivalent of $90 in 21 months. This was another great example of abnormal strength during a weak market. Lorillard did the same thing in the 1957 bear market. Software Toolworks soared in the down market of early 1990. In 1999, Qualcomm made big progress even during its difficult mid-year market, and Taro Pharmaceuticals soared in the last part of 2000. So don't forget, it seldom pays to invest in laggard stocks, even if they look tantalizingly cheap. Look for and confine your purchases to market leaders. Chapter 6. I equals institutional sponsorship. Follow the leaders. It takes big demand to move prices up, and by far the largest source of big demand for stocks is institutional investors, mutual funds, pension funds, banks, etc., who account for the lion's share of each day's market activity. What is institutional sponsorship? Institutional sponsorship refers to the shares of a stock owned by institutions, such as mutual funds, corporate pension funds, insurance companies, large investment counselors, hedge funds, bank trust departments, and state, charitable, and educational institutions. For measurement purposes, I do not consider brokerage research reports or analyst recommendations as institutional sponsorship, although a few may exert strictly short-term influence on some securities. Investment advisory services and market newsletters also aren't considered to be institutional or professional sponsorship by this definition because they lack the concentrated or sustained buying or selling power of institutional investors. A winning stock doesn't need a huge number of institutional owners, but it should have at least several. 10 might be a minimum reasonable number of institutional sponsors, although most stocks have a good many more. If a stock has no professional sponsorship, chances are that its performance will be more run-of-the-mill. Odds are that at least several of more than 1,000 institutional investors have looked at the stock and passed it over. Even if they're wrong, it still takes large buying volume to stimulate an important price increase. Diligent investors go yet another level deeper. They want to know not only how many institutional sponsors a stock has and if that number has increased in recent quarters, but they also want to know who those sponsors are. They look for stocks held by at least one or two of the more savvy portfolio managers who have the best performance records. This is referred to as analyzing the quality of sponsorship. When analyzing the quality of a stock's sponsorship, the latest 12 months plus the last 3-year period of performance of an institutional sponsor are usually the most relevant. One quick and easy way to do this is by checking a fund's 36-month performance rating in Investor's Business Daily. An A+ rating indicates a fund in the top 5% of all funds in terms of performance. Funds with ratings of A- or higher are considered your better performers. However, results may change significantly as key portfolio managers leave one money management firm and go to another. The institutional leaders continually rotate and change. For example, until 1981, the Trust Investment Division of California-based Security Pacific Bank, since merged into Bank of America, enjoyed only modest success, but with the addition of new management and the introduction of more realistic investing concepts, it polished up its act to the point it ranked at the very top in performance in 1982. In 1984, Security Pacific's top manager left and formed his own company, Nicholas Applegate of San Diego, California, which, from its start, has been one of William O'Neill and Company's, our institutional services firm, major clients. Financial services such as Vickers and Weisenberger Thompson Financial publish fund holdings and investment performance records of various institutions. In the past, mutual funds tended to be more aggressive in the market, but banks also manage large amounts of money. More recently, many new entrepreneurial-type investment counseling firms have cropped up to manage institutional monies. As mentioned previously, it's less crucial to know how many institutions own a stock than which of the better-performing institutions own or have bought a stock recently. It's also key to know if the total number of sponsors is increasing or decreasing. The main thing to look for is the recent quarterly trend. It's always best to buy stocks showing an increasing number of institutional owners over several recent quarters. You can also get an overall picture of a stock's sponsorship using Investor's Business Daily's proprietary sponsorship rating found in the stock tables. It ranges from A, best, to E, worst. Stocks with an A rating indicate increased buying by the better money managers in the market. A significant new institutional investment position taken in the most recently reported period is generally more relevant than existing positions held for some time. This is because when a fund establishes a new position, chances are that it will continue to add to that position and may be less likely to sell it in the near future. Reports on such activities, which are available about 6 weeks after the end of a fund's quarter or 6-month period, are very helpful to those who can identify the wiser picks and who understand correct timing and the proper analysis of daily and weekly charts. Many investors feel disclosure of a fund's new commitments are published too long after the fact to be of any real value. This is really not true. Institutional trades also tend to show up on the ticker tape in transactions from 1,000 to 100,000 shares or more. Institutional buying and selling account for more than 70% of the activity in most leading companies. This is the sustained force behind most important price moves. It's important to note that about half the institutional buying that shows up on the New York Stock Exchange ticker tape may be in humdrum stocks. Much of it may also be wrong, but out of the other half, you may have some truly phenomenal selections. Your task, then, is to separate intelligent, highly informed institutional buying from poor, faulty buying. Though difficult, this will become easier as you learn to apply and follow the proven rules, guidelines, and principles presented in this book. To gain a better sense for what works in the market, it's important to study the investment strategies of well-managed mutual funds. When reviewing Investors Business Daily's mutual fund tables, look for funds with A ratings and then call to obtain a prospectus. In doing so, you'll learn the investment philosophy and techniques used by certain funds. It is possible for a stock to have too much sponsorship. Over-owned is a term we coined in 1969 to describe stocks whose institutional ownership had become excessive. The danger is that excessive sponsorship might translate into large potential selling if something goes wrong at the company or a bear market begins. Janus Funds alone owned more than 250 million shares of Nokia and 100 million shares of America Online that contributed to an adverse supply-demand imbalance in 2000 and 2001. WorldCom in 1999 and JDSU, Nokia, and Cisco Systems in 2000 and 2001 were examples of over-owned stocks. Thus, the favorite 50 and other widely owned institutional stocks can be rather poor, potentially risky prospects. By the time a company's attractive performance is so obvious that almost all institutions own the stock, it's probably too late to climb aboard. The heart is already out of the watermelon. For instance, stocks such as America Online in the summer of 2001 and Cisco Systems in the summer of 2000 are examples of those that were over-owned by more than 1,000 institutions. This potential heavy supply can adversely affect a stock during bear market periods. While it may seem like some stocks are invincible, the old saying is true: what goes up must eventually come down. No company is immune forever from management problems, economic slowdowns, and changes in market direction. The savvy investor knows that in the stock market there are few sacred cows. For instance, in June 1974, no one could believe it when William O'Neill and Company put Xerox on its institutional sell list at $115. Xerox was then one of the most widely held institutional stocks and had been amazingly successful up to that point, but our research indicated it had topped and was headed down. It was also over-owned. However, institutional investors went on to make Xerox their most widely purchased stock for that year. When the stock tumbled in price, it showed the true condition of the company at that time. The episode did bring widespread attention to our institutional services firm and our first global insurance company account, American International Group, AIG, in New York City. The company had been buying Xerox on the way down in the 80s until we persuaded them they should be selling instead of buying. We also received a lot of argument in 1998 when we put Gillette, another sacred cow, on our avoid list near $60 before it tanked. Enron was removed from our buy list on November 29, 2000, at $72.91 due to its poor action. Another benefit to you as an individual investor is that institutional sponsorship provides buying support when you want to get out of your investment. If there's no sponsorship and you try to sell your stock in a poor market, you may have problems finding someone to buy it. Daily marketability is one of the tremendous advantages of owning stock in the United States. Real estate is far less liquid, and commissions and fees are much higher. Institutional sponsorship provides continuous liquidity. In summary, only buy stocks that have at least a few institutional sponsors with better-than-average recent performance records, and invest in stocks showing an increasing total number of institutional owners in recent quarters. Utilize institutional sponsorship and always make it an extremely important tool as you research a stock for purchase. Chapter 7. M equals market direction, how to determine it. You can be right on every one of the factors in the first 6 chapters, but if you're wrong about the direction of the general market, 3 out of 4 of your stocks will plummet with the market averages, and you will certainly lose money big time, as many people did in 2000. Therefore, in your analytical toolkit, you absolutely must have a reliable method to determine if you're in a bull, up market, or a bear, down market. But that's not enough. If you're in a bull market, are you in the early stage or the latter stage? And more importantly, what is the market doing right now? Is it weak and acting badly, or is it merely going through a normal decline, typically 8% to 12%? Is the market doing just what it should be based on current conditions in the country, or is it acting abnormally strong or weak? In order to answer these and other vital questions, you'll want to learn to analyze the overall market correctly, and you must start at the most logical point. The best way to determine the direction of the market is to follow, interpret, and understand what the general market averages are doing every day. It might sound overwhelming at first, but with patience and practice, you'll soon be analyzing the market like a pro. This is the most important lesson you can learn. Remember, don't let anyone tell you that you can't time the market. We've heard from thousands of readers of this chapter and IBD's The Big Picture column who have done just that. As a result, they had the foresight to sell stocks and raise cash in March 2000, protecting much of their gains made during 1998 to 1999. The erroneous belief that no one can time the market evolved more than 30 years ago, when most mutual funds that tried it weren't successful at it. This is because they had to both sell exactly right and then get back in the market at exactly the right time. But due to their asset size problems, it took weeks to raise cash and weeks to re-enter the market. Funds lost relative performance during the fast turnarounds that frequently happen at market bottoms, called the bounce-back effect. Therefore, the top management at these mutual funds imposed rules on their money managers that required them to remain fully invested, 95% to 100% of assets. This fits well with the sound concept that mutual funds are truly long-term investments. Also, because funds are typically widely diversified, owning 100 or more stocks spread among many industries, in time they will recover as the market recovers. What is the general market? The general market is a term that usually refers to the most commonly used market indices. These indices tell you the approximate strength or weakness in each day's overall trading activity and can be one of your earliest indications of emerging trends. These indices include the Standard & Poor's S&P 500. Consisting of 500 companies, this index is a broader, more modern representation of market action than the Dow. New York Stock Exchange-traded stocks are featured prominently in this index, as opposed to stocks traded on the American Stock Exchange and the Nasdaq, which are featured less prominently. The Dow Jones Industrial Average, DJIA. This index consists of 30 widely traded stocks, and while it used to focus primarily on large, cyclical industrial issues, it has broadened a little in recent years to include companies like Coca-Cola and Home Depot. It's a simple but rather out-of-date average to study because it's dominated by established, old-line companies that grow more slowly than today's more modern, entrepreneurial companies. Also, its 30 stocks can be more easily manipulated over short time periods. The Nasdaq Composite. The more relevant and volatile index in recent years, the Nasdaq is home to the market's younger, more innovative and fast-growing companies. It includes over 4,000 companies that trade via the Nasdaq network of market makers, and it is more heavily weighted toward the technology sector. Why is skilled, careful market observation so important? A Harvard professor once asked his students to do a special report on fish. His scholars went to the library, read books about fish, and then wrote their expositions. The students were shocked when, after turning in their papers, the professor tore them up and threw them in the wastebasket. When they asked what was wrong with the reports, the professor said, "If you want to learn anything about fish, sit in front of a fishbowl and look at fish." He then made his students sit and watch fish for hours. Then they rewrote their assignment solely on their observations of the objects themselves. Being a student of the market is like being a student in this professor's class. If you want to learn about the market, you must observe and study the major indices carefully. In doing so, you'll come to recognize meaningful changes in the daily market average's behavior at key turning points, like market tops and bottoms. and learn to capitalize upon them. Recognizing when the market has hit a top or has bottomed out is frequently 50% of the whole complicated ballgame. It's also the key investing skill virtually all amateur and professional investors alike seem to lack. In fact, Wall Street analysts completely missed calling the market top in 2000, particularly the top in every one of the high technology leaders. The stages of a stock market cycle. The winning investor should understand how a normal business cycle unfolds and over what period of time. Particular attention should be paid to recent cycles. There's no guarantee that just because cycles lasted 3 or 4 years in the past, they'll last that long in the future. Bull and bear markets don't end easily. It usually takes 2 or 3 pullbacks to fake out or shake out the few remaining speculators. After everyone who can be run in or run out has thrown in the towel, there isn't anyone left to take action in the same direction. Then the market will finally turn and begin a whole new trend. Bear markets usually end while business is still in a downtrend. The reason is that stocks are anticipating or discounting economic events months in advance. Similarly, bull markets usually top out and turn down before a recession sets in. For this reason, use of economic indicators to tell you when to buy or sell stocks is not recommended. Yet some investment firms do this very thing. The predictions of many economists also leave a lot to be desired. A few of our nation's presidents have had to learn this lesson the hard way. In early 1983, just as the economy was in its first few months of recovery, the head of President Reagan's Council of Economic Advisers was a little concerned. The capital goods sector was not very strong, he fretted. This was the first hint that this advisor might not be as sound as he should be. Had he understood historical trends, he would have seen that capital goods demand had never been strong in the early stage of recovery, especially in the first quarter of 1983, when U.S. plants were operating at a low percentage of capacity. You should check earlier cycles to learn the sequence of industry group moves at various stages of the market. For example, railroad equipment, machinery, and other capital goods industries are late movers in a business or stock market cycle. This knowledge can help you get a fix on where you are now. When these groups start running up, you know you're near the end. In early 2000, it was computer companies supplying internet, capital goods, and infrastructure that were the last stage movers, along with telecommunications equipment suppliers. Dedicated market students who want to learn more about cycles and the longer-term history of U.S. economic growth may want to write to Securities Research Company, 101 Prescott Street, Wellesley Hills, Massachusetts, 02481, and purchase one of their long-term wall charts. Some charts of market averages include major news events over the last 12 months. These can be very valuable, especially if you keep and review back copies. You then have a history of both the market averages and events that have influenced their direction. It helps to know, for example, how the market has reacted to new faces in the White House, rumors of war, controls on wages and prices, changes in discount rates, or just to panics in general. Study the general market every day. In bear markets, stocks usually open strong and close weak. In bull markets, they tend to open weak and close strong. The general market averages need to be studied closely every day, since reverses in trends can begin on any given day. Relying on these primary indices is a much more practical and effective method for analyzing the market's behavior and determining its direction. Don't rely on other subsidiary indicators because they haven't been proven as effective. Listening to the many market newsletter writers, technical analysts, or strategists who pore over 30 different technical or economic indicators and then tell you what they think the market should be doing is generally a waste of time. Investment newsletters can create doubt, uncertainty, and confusion in an investor's mind. Interestingly enough, history shows that the market tends to go up just when these experts are most skeptical and uncertain. You must sell when the general market tops to raise at least some cash, as well as get off margin, using borrowed money, in order to protect your account. As an individual investor, you can easily raise cash and get out in 1 or 2 days, and can likewise re-enter later when the market is right. If you don't sell and raise cash when the general market tops, your diversified list of former market leaders can decline sharply, and several may never recover to former levels. Your best bet is to learn to interpret daily price and volume charts of the key general market averages. If you do, you can't get too far off track, and you won't need much else. It doesn't pay to argue with the market. Experience teaches that fighting the market can be a very expensive lesson. The importance of knowing the direction of the general market cannot be overemphasized. A 33% loss in a portfolio of stocks requires a 50% gain just to get to your break-even point. For example, if a $10,000 portfolio is allowed to decline to $6,666, a 33% decline, the portfolio has to rise $3,333, or 50%, just to get you back where you started. You positively must always act to preserve as much as possible of the profit that you've built up during the bull market, rather than ride your investments back down through difficult bear market periods. To do this, you have to learn historically proven selling rules. Many investors like to think of, or at least describe themselves, as long-term investors. Their strategy is to stay fully invested through thick and thin. Some institutions do the same thing, but this inflexible approach can bring tragic results, particularly for individual investors. Individuals and institutions alike may get away with standing pat through relatively mild, 20% or less, bear markets, but many bear markets are not mild. Some are downright devastating. The problem always comes at the beginning, when you start to sense an impending bear market. You cannot, in every case, project how bad economic conditions might become, or how long they could linger. For example, the war in Vietnam, inflation, and a tight money supply helped turn the 1969-1970 correction into a 2-year decline of 36.9%. Before that, bear markets averaged only 9 months and took the averages down 26%. Most stocks fall during a bear market, but not all of them recover. If you hold on during even a modest bear correction, you can get stuck with damaged merchandise that may never see its former highs. You must learn to sell when the overall environment changes and your stocks are not working. Buy and hold investors fell in love with Coca-Cola during the 1980s and 1990s. The soft drink maker chugged higher year after year, rising and falling with the market, but it stopped working in 1998, along with Gillette. When the market slipped into its mild bear correction that summer, Coke followed along. 2 years later, after some of the market's most exciting gains in decades, Coke was still stuck in a downtrend. In some instances, these kinds of stocks may come back, but this much is certain. Coke investors missed huge advances in names such as America Online and Qualcomm. The buy-and-hold strategy was also disastrous to anyone who held technology stocks in 2000. Many high flyers lost 75% to 90% of their value, and some will never return to their prior highs. Protecting yourself from market downturns. Napoleon once wrote that never hesitating in battle gave him an advantage over his opponents, and for many years he was undefeated. In the battlefield that is the stock market, there are the quick and there are the dead. After you see the first definite indications of a market top, don't wait around. Sell quickly before real weakness develops. When market indices peak and begin major downside reversals, you should act immediately by raising 25% or more cash, selling your stocks at market prices. Use of limit orders, buying or selling at a specific price, as opposed to a market order, which is bought or sold at market prices, is not recommended. The thing to focus on is your ability to get in or out of a stock when you need to. By quibbling over an eighth or quarter point, or their decimal equivalents, you could miss your opportunity to buy or sell a stock. Lightning-fast action is even more critical if your stock account is on margin. If your portfolio is fully margined, with half of the money in your stocks borrowed from your broker, a 20% decline in the price of your stocks will cause you to lose 40% of your money. A 50% decline in your stocks could wipe you out. In the final analysis, there are only two things you can really do when a new bear market begins: sell and get out, or go short. When you get out, you should stay out until the bear market is over. This usually means 5 or 6 months, but in the prolonged, problem-ridden 1969, 1970, and 1973, 1974 periods, it meant 2 years. In addition, the bear market that began in March 2000, during the last year of the Clinton administration, lasted longer and was more severe than normal. 9 out of 10 investors lost a lot of money, particularly in high-tech stocks. It was the end of a period of many excesses during the late 1990s. It was a decade where America got careless and let its guard down. Selling short can be profitable, but it's a very difficult and highly specialized skill that should only be attempted during bear markets. But be forewarned, few people make money shorting. If stop-loss orders are used or mentally recorded and acted upon, a market that is starting to top out will mechanically force you, robot-like, out of many of your stocks. A stop-loss order instructs the specialist in the stock on the exchange floor that once the stock drops to your specified price, it then becomes a market order and will be sold out on the next transaction. It's usually better not to enter stop-loss orders. In doing so, you and other similarly minded investors are showing your hand to market makers. At times, they might drop the stock to shake out stop-loss orders. Instead, watch your stocks closely and know ahead of time the exact price at which you will immediately sell to cut a loss. However, some people travel a lot and aren't able to watch their stocks closely. Others have a hard time making sell decisions and getting out when they are losing. In such cases, stop-loss orders help protect against distance and indecisiveness. If you use them, remember to cancel the stop-loss order if you change your mind and sell a stock before the stop-loss order is executed. Otherwise, you could later accidentally sell a stock you no longer own. Such errors can be costly. To detect a market top, keep a close eye on the daily S&P 500, Dow 30, and NASDAQ Composite as they work their way higher. On one of the days in the uptrend, volume for the market as a whole will increase from the day before, but the average itself will show stalling action. Significantly less price increase for the day compared to the prior day's price increase. I call this heavy volume without further price progress up. The average doesn't have to close down for the day, but in most instances it will, making it much easier to see the distribution, selling, as professional investors liquidate stock. The spread from the average's daily high to its daily low may be a little wider than on previous days. Normal liquidation near the market peak will usually occur on 3 to 5 days, over 1, 2, or 3 weeks. In other words, the market comes under distribution while it is advancing. This is one reason so few people know how to recognize distribution. After 4 or 5 days of definite distribution, the general market will almost always turn down. 4 days of distribution, if correctly spotted over a 2 or 3 week period, are often enough to turn a previously advancing market into a decline. Sometimes distribution can be spread over 6 or 7 weeks if the market attempts to rally back to new highs. If you miss the topping signals given off by the S&P 500, NASDAQ, or Dow, which is easy to do since they sometimes occur on only a few days, you could be wrong about the market direction and therefore wrong on almost everything you do. One of the biggest problems is the time it takes to reverse investors' positive personal opinions and views. If you sell and always cut all losses, 7% or 8% below your buy points, you will automatically be forced into selling at least some stocks as a correction in the general market starts to develop. This should get you into a questioning, defensive frame of mind sooner. Following this one simple but powerful rule of ours saved a lot of people big money in 2000's devastating decline in technology leaders. Right after the first selling near the top, A vacuum exists where volume may subside and the market averages will sell off for 4 days or so. The second, and probably last early chance to recognize a top reversal, is when the market attempts its first rally. This usually comes several days down from the peak. Most stock market technicians are fooled by the initial market decline off the top if they see volume contracting. They don't understand that this is a normal occurrence after heavy volume distribution has occurred on the way up around the top. Volume begins to pick up on the downside days or weeks later, when the weakness becomes obvious to more investors. As in anything else, if you wait until the writing's on the wall, it's going to cost you more. You'll be selling late. Following several days of increased volume distribution around the top and the first decline resulting from it, there will be either a poor rally in the market averages followed by a rally failure, or a positive and powerful follow-through on price and volume. You should learn in detail exactly what signals to look for and remain unbiased about the market. Let the day-by-day market averages tell you what the market has been doing and is doing. After the market does top out, it typically will rally feebly and then fail. For instance, after the first day's rebound, the second day will open strongly, but toward the end of the session, the market will suddenly close down. The abrupt failure of the market to follow through on its first recovery attempt should probably be met by further selling on your part. You'll know the initial bounce back is feeble if 1. The index advances in price on the third, fourth, or fifth rally day, but on volume lower than the day before. 2. The average makes little net upward price progress compared with the progress the day before. Or 3. The market average recovers less than half of the initial drop from its former absolute intraday high. Further selling is advisable when you see these weak rallies and failures. How CAN-SLIM and IBD red-flagged the March 2000 NASDAQ top. In October 1999, the market took off on a furious advance. Fears of a Y2K meltdown on January 1st had faded. Companies were announcing strong profits from the third quarter, which had just ended the month prior. Leading tech stocks, as well as speculative internet and biotechnology issues, racked up huge gains in just 5 months. But cracks started to appear in early March 2000. Many leaders suffered from classic climax tops. On March 7th, the NASDAQ closed lower on higher volume, the first instance in more than 6 weeks. That's unusual action during a roaring bull market, but one day of distribution isn't always significant on its own. Still, it was a yellow flag, worth carefully watching. 3 days later, the NASDAQ bolted more than 85 points to a new high in the morning, but reversed in the afternoon. It finished the day up only 2 points, as volume remained heavy. That churning action, a lot of trading action but no real progress, a clear sign of distribution, was all the more important because leading stocks started showing their own symptoms of hitting a climax top. Over the next week, many leaders broke down as the NASDAQ corrected 13%. The index managed to put together a suspect rally from March 16th to 24th, but it soon ran out of steam and rolled over in heavier volume, a final, definite confirmation of the March 10th top. During the next 2 weeks, the NASDAQ, as well as the S&P 500 and Dow, suffered repeated bouts of distribution as the indices sold off in heavier volume than the prior day. Astute CAN-SLIM investors had all long since taken their profits. The second most important indicator of primary changes in market direction after the daily averages is the way leading stocks act. After the market has advanced for a couple of years, you can be fairly sure it's headed for trouble if most of the individual stock leaders start acting abnormally. One example of abnormal activity can be seen when leading stocks break out of third or fourth stage chart base formations on the way up. Most of these base structures will be faulty, with price fluctuations appearing much wider and looser. A faulty base, wide, loose, and erratic, can best be recognized and analyzed by studying charts of a stock's daily or weekly price and volume history. Another sign of abnormal activity is the climax top. Here, a leading stock will run up more rapidly for 2 or 3 weeks in a row after having advanced for many months. A few leaders will have their first abnormal price break off the top on heavy volume and then be unable to rally more than a small amount from the lows of their correction. Still others will show a serious loss of upward momentum in their most recent quarterly earnings reports. Shifts in market direction can also be detected by reviewing the last 4 or 5 stock purchases in your own portfolio. If you haven't made a dime on any of them, you could be picking up signs of a new downtrend. Investors who use charts and understand market action know that there are very few leading stocks that will be attractive around market tops. There simply aren't any stocks coming out of sound chart bases that can be bought. Most bases are wide, loose, and erratic, a giant sign of real danger you must learn to understand and obey. Also, the tendency is for laggard stocks to show strength at this stage. The sight of sluggish or low-priced, lower-quality laggards strengthening is a signal to the wise market operator that the upward market move may be near its end. Even turkeys can try to fly in a windstorm. During bear markets, certain leading stocks will seem to be bucking the trend by holding up in price, creating the impression of strength. But what you're seeing is just a postponement of the inevitable. When they raid the house, they usually get everyone, and eventually all the leaders will succumb to the selling. This is exactly what happened in the 2000 bear market. Cisco and other high-tech leaders all eventually collapsed, in spite of how many analysts incorrectly said they should be bought. Market tops, whether intermediate, usually 8% to 12% declines, or primary bull market peaks, sometimes occur 5, 6, or 7 months after the last major buy point in leading stocks and in the averages. Thus, top reversals are usually late signals, the last straw before a cave-in. In most cases, distribution or selling has been going on for days or even weeks in individual market leaders. Use of individual stock selling rules should have already led you to sell 1 or 2 of your holdings on the way up, just before the market peak. When the original market leaders begin to falter, you may see lower-priced, lower-quality, more speculative stocks begin to move up. Watch out. When the old dogs begin to bark, the market is on its last feeble leg. Among the telltale signs are the poor quality stocks that start to dominate the most active list on market up days. It's simply a matter of weak leadership trying to command the market. If the best ones can't lead, the worst certainly aren't going to for very long. Many top reversals, when the market closes at the bottom of its trading range after making a new high that day, have occurred from the 3rd to the 9th day of a rally after the averages moved into new high ground off small chart bases, meaning the time span from the start to the end of the pattern is short. It's important to note the conditions under which the tops occurred were all about the same. At other times, a topping market will recover for a couple of months and get back near or even above its old high before breaking down in earnest. This occurred in December 1976, January 1981, and January 1984. There's an important psychological reason for this. The majority of people in the market can't be exactly right at exactly the right time. In 1994, the Nasdaq didn't top until weeks after the Dow did. A similar thing happened in early 2000. The majority in the stock market will be fooled first. This includes both professional and individual investors. If you were smart enough to sell or sell short in January 1981, the powerful rebound in February and March probably forced you to cover your short sales at a loss or buy some stocks back during the strong rally. It was an example of how treacherous the market really is. I didn't have much problem recognizing and acting upon the early signs of the many bear markets from 1962 through 2000, but a couple of times I made the mistake of buying back too early. When you make a mistake in the stock market, the only sound thing to do is correct it. Pride and ego never pay off. Neither does vacillation when losses start to show up. The typical bear market, and some aren't typical, usually has 3 separate phases, or legs, of decline, interrupted by a couple of rallies that last just long enough to convince investors to begin buying. In 1969 and 1974, a few of these phony, drawn-out rallies lasted up to 15 weeks. Most don't last that long. Many institutional investors love to bottom fish. They'll start buying stocks off a supposed bottom and help make the rally convincing enough to draw you in. You're better off staying on the sidelines in cash until a real new bull market starts. Once you've recognized a bear market and have scaled back your stock holdings, the big question is how long you should remain on the sidelines. If you plunge back in the market too soon, the apparent rally may fade and you'll lose money. But if you hesitate at the brink of the eventual roaring recovery, opportunities will pass you by. Again, the daily general market averages provide the best answer by far. At some point in every correction, whether mild or severe, the stock market will always attempt to rally. Don't jump back in right away. Wait for the market itself to confirm the new uptrend. A rally attempt begins when a major market average closes higher after a decline, either from earlier in the day or the previous session. For example, the Dow plummets 3% in the morning, but then recovers later in the day and closes higher. Or the Dow closes down 2% and then rebounds the next day. The session in which the Dow closes higher is the first day of the attempted rally. Sit tight and be patient. The first few days of improvement can't tell you if the rally will succeed. Starting on the 4th day of the attempted rally, look for one of the major averages to follow through, meaning it shows a booming 2% or more gain on heavier volume than the day before. This tells you the rally is much more likely to be real. The most powerful follow-throughs usually occur on the 4th to 7th days of the rally. Follow-throughs after the 10th day may indicate a positive but somewhat weaker new uptrend. A follow-through day should give the feeling of an explosive rally that is strong, decisive, and conclusive, not begrudging and on the fence, barely up 1%. The market's volume for the day should be above its average daily volume, in addition to always being higher than the prior day's trading. Occasionally, a follow-through occurs as early as the 3rd day of the rally. In such a case, the 1st, 2nd, and 3rd days must all be very powerful, with a major average up 1% to 2% or more each session in heavy volume. I used to use 1% as the required percentage increase for a valid follow-through day. However, in recent years, as institutional investors learned of our system, we've moved up the requirement to 2% to minimize professionals manipulating a few stocks in the Dow averages to create false or faulty follow-through days. There will be a few cases in which confirmed rallies fail. A few large institutional investors, armed with their immense buying power, can run up the averages on a particular day and create the impression of a follow-through. Unless the smart buyers are back on board, the rally will implode, usually crashing in heavy volume within the next day or two. However, just because the market corrects the day after a follow-through, it doesn't mean the follow-through was false. When a bear market bottoms, it frequently pulls back and settles above or near the lows made during the previous few weeks. It is more constructive when these pullbacks, or tests, hold up at least a little above the absolute intraday lows made recently in the market averages. A follow-through signal doesn't mean you should rush out and buy with abandon. It gives the go-ahead to begin buying quality stocks as they break out of sound price bases, and it is a vital second confirmation that the attempted rally is succeeding. Remember, no new bull market has ever started without a strong price and volume follow-through confirmation. It pays to wait and listen to the market. The really big money is usually made in the first 1 or 2 years of a normal bull market cycle. It is at this point you must recognize and fully capitalize upon the golden opportunities presented. The rest of the upcycle usually consists of back-and-forth movement in the market averages, followed by a bear market. The year 1965 was one of the few exceptions, but that strong market in the 3rd year of a new cycle was caused by the beginning of the Vietnam War. In the first or second year of a new bull market, you should have a few intermediate-term declines in the market averages. These usually last a couple of months, with the market indices dropping 8% to an occasional 15%. After several sharp downward adjustments of this nature, and once 2 years of a bull market have passed, heavy volume without further upside progress in the daily market averages could indicate the beginning of the next bear market. Since the market is governed by supply and demand, you can decipher a chart of the general market averages about the same way as you read the chart of an individual stock. The Dow Jones Industrial Average and S&P 500 are displayed prominently in the better publications. Investors Business Daily displays the NASDAQ Composite, Dow, and S&P 500 stacked on one page for easier comparison. These charts should show the high, low, and close of the market averages day by day for 6 to 12 months, together with the daily New York Stock Exchange and NASDAQ volume in millions of shares traded. Normal bear markets show 3 legs of price movement down, but there's no rule saying you can't have 4 or even 5 down legs. You have to objectively evaluate overall conditions and events in the country and let the market averages tell their own story. And you have to understand what that story is. Additional ways to identify key market turning points. Look for divergence of key averages. Several averages should be checked at market turning points to see if there are significant divergences, meaning they are moving in different directions, one up and one down, or one is advancing or declining at a much greater rate from another. For example, if the Dow is up 100 and the S&P 500 is up only the equivalent of 20 on the Dow for the day, the S&P 500 being a broader index, it would indicate the rally is not as broad and strong as it appears. To compare the S&P 500 change to the Dow, divide the S&P 500 into the Dow average and then multiply by the change in the S&P 500. For example, if the Dow closed at 10,000 and the S&P 500 finished at 2,500, the 10,000 Dow would be 4 times the S&P 500 index. Therefore, if the Dow on a particular day is up 100 points and the S&P 500 is up 10, you can multiply the 10 by 4 and find that the S&P 500 was only up the equivalent of 40 points on the Dow. The Dow's new high in January 1984 was accompanied by a divergence in the indices. The broader-based, more significant S&P 500 did not hit a new high. This is the reason most professionals plot the key indices together, to make it easier to spot non-confirmations at key turning points. Institutional investors periodically run up the 30-stock Dow, while the broader NASDAQ is under liquidation. Certain psychological market indicators can help. Now that speculation in put and call options is the get-rich-quick scheme for many investors, you can plot and analyze the ratio of calls to puts for another valuable insight into crowd temperament. Options traders buy calls, which are options to buy common stock, or puts, which are options to sell common stock. A call buyer hopes prices will rise. A buyer of put options wishes prices to fall. If the volume of call options in a given period of time is greater than the volume of put options, one may logically assume that option speculators as a group are expecting higher prices and are bullish on the market. If the volume of put options is greater than that of calls, speculators hold a bearish attitude. When option players buy more puts than calls, the put-to-call ratio index increases above 1.0, which coincided with general market bottoms in 1990, 1996, 1998, and April and September 2001. The percentage of investment advisors who are bearish is an interesting measure of investors' sentiments. When bear markets are near the bottom, the great majority of advisory letters will usually be bearish. Near market tops, most will be bullish. The majority is usually wrong when it's most important to be right. However, you cannot blindly assume that because 65% of investment advisors were bearish the last time the general market hit bottom, A major market decline will be over the next time the investment advisor's index reaches the same point. The short interest ratio is the amount of short selling on the New York Stock Exchange, expressed as a percentage of total New York Stock Exchange volume. This ratio can reflect the degree of bearishness shown by speculators in the market. Along bear market bottoms, you will usually see 2 or 3 major peaks, showing sharply increased short selling. There's no rule governing how high the index should go, but studying past market bottoms can give you an idea of what the ratio looked like at key market junctures. An index sometimes used to measure the degree of speculative activity is the NASDAQ volume as a percentage of New York Stock Exchange volume. This measure provided a helpful tip-off of impending trouble during the summer of 1983, when NASDAQ volume significantly increased relative to the big boards, New York Stock Exchange. When a trend persists and accelerates, indicating wild, rampant speculation, you're close to a general market correction. Interpret the overrated advanced decline line. Some technical analysts religiously follow advanced decline, AD, data. Technicians take the number of stocks advancing each day versus the number declining, and then plot that ratio on a graph. Advanced decline lines are far from precise because they frequently prematurely veer down sharply, long before a bull market finally tops. In other words, the market keeps advancing toward higher ground, but is being led by fewer but better stocks. The advanced decline line is simply not as accurate as the key general market indexes because analyzing the market's direction is not a total numbers game. All stocks are not created equal. It's better to know where the real leadership is and how it's acting than it is to know how many more mediocre stocks are advancing and declining. The New York Stock Exchange AD line peaked in April 1998. It trended lower during the new bull market that broke out 6 months later in October. The AD line continued to fall from October 1999 to March 2000, missing one of the market's most powerful rallies. An advanced decline line can sometimes be helpful when a clear-cut bear market attempts a short-term rally. If the AD line lags the market averages and can't rally, it's giving an internal indication that, despite the rally's strength in the Dow or S&P, the broader market remains frail. In such instances, the rally usually fizzles. In other words, it takes more than just a few leaders to make a new bull market. At best, the advanced decline line is a secondary indicator of limited value. If you hear commentators or TV market strategists extolling its virtues bullishly or bearishly, they probably haven't done their homework. Watch Federal Reserve Board rate changes. Among fundamental general market indicators, changes in the Federal Reserve Board's discount rate, the interest rate the Fed charges member banks for loans, the Fed funds rate, the interest rate that banks with fund reserves charge for loans to banks without fund reserves, and occasionally stock margin levels are valuable indicators to watch. As a rule, interest rates provide the best confirmation of basic economic conditions, and changes in the discount rate and Fed funds rate are by far the most reliable. 3 successive significant hikes in the discount rate have generally marked the beginning of bear markets and impending recessions. Bear markets have usually, but not always, ended when the rate was finally lowered. On the downside, the discount rate increased to 6% in September 1987, just after Alan Greenspan became chairman, led to the severe market break that October. Money market indicators mirror general economic activity. At times, I follow selected government and Federal Reserve Board measurements, including 10 indicators of the supply and demand for money and indicators of interest rate levels. History proves that the direction of the general market, as well as of several industry groups, is often affected by changes in interest rates because the level of interest rates is usually tied to tight or easy Fed monetary policy. For the investor, the simplest and most relevant monetary indicators to follow and understand are the changes in the Federal Reserve Board discount rate and the Fed funds rate. With the advent of program trading and various hedging devices, some funds hedge portions of their portfolio in an attempt to provide some downside protection during risky markets. The degree to which these are successful again depends greatly on skill and timing, but one possible effect for some managers may be to lessen the pressure to dump portfolio securities on the market. The hourly market index and volume changes. At key turning points, an active market operator can watch market indices and volume changes hour by hour and compare them to volume in the same hour of the day before. A good time to watch hourly volume figures is during the first attempted rally following the initial decline off the market peak. You should be able to see if volume is dull or dries up on the rally. You can also see if the rally starts to fade late in the day, with volume picking up as it does, a sign that the rally is weak and will probably fail. Hourly volume data also come in handy when the market averages reach an important prior low point and start breaking that support area. A support area is a previous price level below which investors hope an index will no longer continue to fall. What you want to know is whether selling picks up dramatically or by just a small amount as the market collapses into new low ground. If selling picks up dramatically, this will represent significant downward pressure on the market. After the market has undercut previous lows for a few days, but on only slightly higher volume, look for 1 or 2 days of increased volume without the general market index going lower. If you see this, you may be in a shakeout area, when the market pressures many traders to sell, often at a loss, ready for an upturn after scaring out weak holders. This occurred on April 23rd and 24th, 1990. Overbought, oversold. 2 risky words. The short-term overbought, oversold indicator has an avid following among some individual technicians and investors. It's a 10-day moving average of advances and declines in the market. But be careful. At the start of a new bull market, the overbought, oversold index can become substantially overbought. This should not be taken as a sign to sell stocks. A big problem with indices that move counter to the trend is that you always have the question of how bad it can get before everything finally turns. Many amateurs follow and believe almost religiously in overbought, oversold indicators. Something similar can happen in the early stage or first leg of a major bear market, when the index becomes unusually oversold. This is really telling you that a bear market may be imminent. The market was oversold all the way down during the brutal market implosion of 2000. I once hired a well-respected professional who relied on such technical indicators during the 1969 market break, at the very point when everything told me the market was getting into serious trouble, and I was aggressively trying to get several portfolio managers to liquidate stocks and raise large amounts of cash. He was telling them that it was too late to sell because his overbought, oversold indicator said the market was already very oversold. You guessed it, the market then split wide open. Needless to say, I rarely pay attention to overbought, oversold indicators. What you learn from years of experience is usually more important than the opinions and theories of experts using their many different favorite indicators. Other general market indicators. Upside-downside volume is a short-term index that relates trading volume in stocks that close up in price for the day to volume in stocks that close down. This index, plotted on a 10-day moving average, may show divergence at some intermediate turning points in the market. For example, after a 10% to 12% dip, the general market averages may continue to penetrate into new low ground for a week or two, yet the upside-downside volume may suddenly shift and show steadily increasing upside volume with downside volume easing. This switch usually signals an intermediate-term upturn in the market. Of course, you'll pick up the same signals if you watch the changes in the daily Dow, Nasdaq, or S&P 500 and market volume. Some services measure the percentage of new money flowing into corporate pension funds that is invested in common stocks and the amount invested in cash equivalents or bonds. This opens another window to institutional investor psychology. However, majority or crowd thinking is seldom right, even when it's done by professionals. Every year or two, Wall Street seems to be of one mind, with everyone following each other like a herd of cattle. They either all pile in or all pile out. An index of defensive stocks, more stable and supposedly safer issues such as utilities, tobaccos, foods, and soaps, may often show strength after a couple of years of bull market conditions. This may indicate smart money slipping into defensive positions and a weaker general market ahead. Also helpful in evaluating the stage of a market cycle is determining the percentage of stocks making new price highs in the defensive or laggard categories. In pre-1983 cycles, some technicians rationalized their lack of concern with market weakness by citing the number of stocks still making new highs. But analysis of new high lists shows that a large percentage of preferred or defensive stocks signal bear market conditions. Superficial knowledge can hurt you in the stock market. To summarize this complex but vitally important chapter, learn to interpret the daily price and volume changes of the general market indices and the action of individual market leaders. Once you know how to do this correctly, you can stop listening to all the costly and uninformed personal market opinions of amateurs and professionals alike. As you can see, the key to staying on top of the stock market is not predicting or knowing what the market is going to do, but knowing what the market has actually done recently and what it is currently doing. We don't want to give personal opinions and predictions. We carefully observe daily market supply and demand as it changes. One of the great values to this system of interpreting the market averages, price, and volume changes is not just the ability to recognize major market tops and bottoms, but also the ability to track each rally attempt when the market is on its way down. By waiting for powerful follow-through days, you can normally prevent yourself from being drawn into the market prematurely when rally attempts ultimately end in failure. In other words, you have rules that will continue to keep you out of a declining market so that you don't get sucked into phony rallies. This is how we were able to stay out of the market and in money market funds for most of 2000 and 2001 and preserve gains made in 1998 and 1999. There is a fortune for you in this paragraph. It isn't enough just to read. You need to remember and apply all of what you read. To help you remember, we've come up with the simple two-word acronym CAN-SLIM. Each letter in CAN-SLIM stands for one of the 7 basic fundamentals of selecting outstanding stocks. Most successful stocks have these 7 common characteristics at emerging growth stages, so they are worth committing to memory. Repeat this formula until you can recall it and use it easily. C equals current quarterly earnings per share. They must be up at least 18% or 20%. The higher the better. Also, quarterly sales should be accelerating or up 25%. A equals annual earnings increases. Require significant growth for each of the last 3 years and a return on equity of 17% or more. N equals new products, new management, new highs. Look for new products or services, new management, or significant new changes in industry conditions. And most important, buy stocks as they emerge from sound chart bases and begin to make new highs in price. S equals supply and demand, shares outstanding plus big volume demand. Any size capitalization is acceptable in today's new economy as long as a company fits all other CAN-SLIM rules. Look for big volume increases when a stock begins to move out of its basing area. L equals leader or laggard. Buy market leaders and avoid laggards. Buy the number 1 company in its field. Most leaders' relative price strength rating will be 80 to 90 or higher. I equals institutional sponsorship. Buy stocks with increasing sponsorship and at least a few institutional sponsors with top-notch recent performance records. Also look for companies with management ownership. M equals market direction. Learn to determine overall market direction by accurately interpreting the daily market indices, price and volume movements, and the action of individual market leaders. This can determine whether you win big or lose. On Wall Street, wise men can be just as easily drawn into booby traps as fools. From what I've seen, in fact, the length and quality of one's education have very little to do with making big money investing in the market. The more intelligent people are, the more they think they know what they're doing, and the more they may have to learn the hard way how little they really know about outsmarting the stock market. The few people I've known over the years who've been unquestionably successful making money in stocks were decisive individuals without huge egos. The market has a simple way of whittling all excessive pride and overblown egos down to size. After all, the whole idea is to be completely objective and recognize what the marketplace is telling you, rather than try to prove what you said or did yesterday or 6 weeks ago was right. The fastest way to take a bath in the stock market is to try to prove that you are right and the market is wrong. Humility and common sense provide essential balance. Sometimes, the more widely quoted and accepted the expert, the more trouble you can get yourself into. A well-known expert in the spring and summer of 1982 insisted that government borrowing was going to crowd out the private sector, and that interest rates and inflation would soar back to new highs. The exact opposite happened. Inflation broke and interest rates came crashing down. Another expert's bear market call in the summer of 1996 backfired, as it came only one day from the market bottom. In the 2000 bear market, one expert after another kept saying week after week on CNBC that it was time to buy high-tech stocks, only to watch the techs continue to plummet further. Many high-profile analysts and strategists kept telling investors to capitalize on these once-in-a-lifetime buying opportunities on the way down. Buying on the way down can be a dangerous pastime. Conventional wisdom or consensus thinking is seldom right in the market. I never pay any attention to the parade of experts voicing their personal opinions on the market. It just creates entirely too much confusion and can cost you a great deal of money. Some strategists in 2000 were telling people to buy the dips, short-term declines in price, because the cash position of mutual funds had increased greatly, such that there was all this money sitting on the sidelines. All anyone had to do to prove this wrong was to look at the General Markets and Sectors page in Investor's Business Daily. It showed that while mutual fund cash positions had indeed risen, the move was still significantly under historical highs, and even under historical averages. The only thing that works is to let the market indices tell you the time to enter and exit. Never fight the market. It's bigger than you are. Chapter 8. 19 Common Mistakes Most Investors Make. Knute Rockne, the famous winning Notre Dame football coach, used to say, "Build up your weaknesses until they become your strong points." The reason people either lose money or achieve mediocre results in the stock market is they simply make too many mistakes. It's the same in your business, life, or career. You are held back or have reverses, not because of your strengths, but because of your mistakes or weaknesses that you do not recognize and correct. Most people just blame somebody else. It is much easier to have excuses and alibis than it is to realistically examine your own behavior. Since the early 1960s, I have known or dealt with countless individual risk-takers, from inexperienced beginners to smart professionals. What I've discovered is that it doesn't matter whether you're just getting started or have many years, even decades of investing experience. In fact, experience is harmful if it continuously reinforces your bad habits. Success in the market is achieved by avoiding the classic mistakes made most often by the least successful investors. These are the mistakes you must avoid. 1. Stubbornly holding on to losses when they are very small and reasonable. Most could get out cheaply, but because people are human, emotions take over. You don't want to take a loss, so you wait and you hope, until your loss gets so large it costs you dearly. This is by far the number one mistake most investors make. They don't understand that all stocks are highly speculative and can involve huge risks. Without exception, you should cut every single loss short. My rule is to always cut all losses immediately when a stock falls 7% or 8% below my purchase price. Following this simple rule will ensure you will survive another day to invest and capitalize on future opportunities. 2. Buying on the way down in price, thus ensuring miserable results. A declining stock seems a real bargain because it's cheaper than it was a few months earlier. An acquaintance of mine bought International Harvester in March 1981 at $19 because it was down sharply. This was his first investment, and he made the classic Tyro's mistake. He bought a stock near its low for the year. As it turned out, the company was in serious trouble and headed for possible bankruptcy. In late 1999, a young woman I know bought Xerox when it dropped abruptly to a new low at $34 and seemed really cheap. A year later, it traded at $6. Why try to catch a falling dagger? 3. Averaging down in price rather than up when buying. If you buy a stock at $40 and then buy more at $30 and average out your cost at $35, you are following up your losers and putting good money after bad. This amateur strategy can produce serious losses and weigh your portfolio down with a few big losers. 4. Buying large amounts of low-priced stocks rather than smaller amounts of higher-priced stocks. Many think it's smarter to buy more shares in round lots of 100 or 1,000 shares. This makes people feel like they're getting a lot more for their money. They'd be better off buying 30 or 50 shares of higher-priced, better-performing companies. Think in terms of dollars when you invest, not the number of shares you can buy. Buy the best merchandise available, not the cheapest. Many investors can't resist $2, $5, or $10 stocks. But most stocks selling for $10 or less are cheap for a reason. They've either been deficient in the past or have something wrong with them now. Stocks are like anything else. The best quality never comes at the cheapest price. That's not all. Low-priced stocks usually cost more in commissions and markups. And since they can drop 15% to 20% faster than most higher-priced issues, they also carry greater risk. Most professionals and institutions won't normally invest in $5 and $10 stocks, so they do not have a top-notch following. Penny stocks are even worse. As we discussed earlier, institutional sponsorship is one of the ingredients needed to help propel a stock higher in price. Cheap stocks also have larger spreads in terms of the percentage difference between the bid and ask price. Compare a $5 stock that trades $5 bid, 5.25 ask, versus a $50 stock that trades $50 bid, 50.25 ask. On your $5 stock, that quarter difference is almost 5% of the bid price. On your $50 stock, that quarter difference is a negligible 0.5%. The difference is a factor of 10. As a result, with low-priced stocks, you tend to have much more ground to make up from your initial buy point, just to break even and overcome the spread. 5. Wanting to make a quick and easy buck. Wanting too much too fast, without doing the necessary preparation, learning the soundest methods, or acquiring the essential skills and discipline, can be your downfall. Chances are you'll jump into a stock too fast and then be too slow to cut your losses when you are wrong. 6. Buying on tips, rumors, split announcements, and other news events, stories, advisory service recommendations, or opinions you hear from supposed market experts on TV. In other words, many people are too willing to risk their hard-earned money on what someone else says, rather than taking the time to study, learn, and know for sure what they're doing. As a result, they risk losing a lot of money. Most rumors and tips you hear simply aren't true. Even if they are true, in most cases the stock concerned will ironically go down, not up. 7. Selecting second-rate stocks because of dividends or low price earnings, P/E ratios. Dividends and P/E ratios aren't as important as earnings per share growth. In many cases, the more a company pays in dividends, the weaker it may be. It may have to pay high interest rates to replenish funds paid out in the form of dividends. Better-performing companies will typically not issue dividends. Instead, they reinvest their capital into research and development, R&D, or other corporate improvements. Also keep in mind that you can lose the amount of a dividend in 1 or 2 days' fluctuation in the price of the stock. As for P/E ratios, a low P/E is probably low because the company's past record is inferior. Most stocks sell for what they're worth at the time. 8. Never getting out of the starting gate properly due to poor selection criteria and not knowing exactly what to look for in a successful company. Many buy fourth-rate, nothing-to-write-home-about stocks that are not acting particularly well, have questionable earnings, sales growth, and return on equity, and are not the true market leaders. Others overly concentrate in highly speculative or lower-quality, risky technology securities. 9. Buying old names you're familiar with. Just because you used to work for General Motors doesn't necessarily make it a good stock to buy. Many of the best investments will be newer names that you won't know, but which, with a little research, you could discover and profit from before they become household names. 10. Not being able to recognize and follow good information and advice. Friends, relatives, certain stockbrokers, and advisory services might all be sources of bad advice. Only a small minority are successful enough themselves to merit your consideration. Outstanding stockbrokers or advisory services are no more plentiful than outstanding doctors, lawyers, or ball players. Only 1 out of 9 baseball players who sign professional contracts ever make it to the big leagues. Most of the ball players that graduate college simply are not professional caliber. 11. Not using charts and being afraid to buy stocks that are going into new high ground in price. Over 98% of the masses will generally think that a stock making a new high price seems too high, but personal feelings and opinions are far less accurate than the market itself. The best time to buy a stock during a bull market is when the stock initially emerges from a price consolidation or sound basing area of at least 7 or 8 weeks. 12. Cashing in small, easy-to-take profits while holding the losers. In other words, doing exactly the opposite of what you should be doing, cutting losses short and giving your profits more time. 13. Worrying too much about taxes and commissions. The name of the game is to first make a net profit. Excessive worrying about taxes usually leads to unsound investment decisions in the hope of achieving a tax shelter. You can also fritter away a good profit by holding on too long, trying to get a long-term capital gain. Some investors convince themselves they can't sell because of taxes, but that's ego trumping judgment. The commissions associated with buying and selling stocks, especially through an online broker, are minor compared with the money to be made by making the right decisions in the first place and taking action when needed. The fact that you pay relatively low commissions and can get out of your investment much faster are 2 of your biggest advantages of owning stock over real estate. With instant liquidity, you can protect yourself quickly at low cost and take advantage of highly profitable new trends as they continually evolve. 14. Concentrating your time on what to buy, and once the buy decision is made, not understanding when or under what conditions the stock must be sold. Most investors have no rules or plan for selling stocks, doing only half of the homework necessary to succeed. 15. Failing to understand the importance of buying quality companies with good institutional sponsorship, and the importance of learning how to use charts to significantly improve selection and timing. 16. Speculating too heavily in options or futures because they're thought to be a way to get rich quick. Some investors also focus mainly on shorter-term, lower-priced options that involve greater volatility and risk. The limited time period works against short-term option holders. Some also write naked options, selling options on stocks they do not even own, which amounts to taking great risk for a potentially small reward. 17. Rarely transacting at the market and preferring to put price limits on their buy and sell orders. By doing so, they're quibbling for eighths and quarters of a point, or their decimal equivalents, rather than focusing on the stock's larger and more important movement. With limit orders, you run the risk of missing the market completely and not getting out of stocks that should be sold to avoid substantial losses. 18. Not being able to make up your mind when a decision needs to be made. Many don't know if they should buy, sell, or hold, and the uncertainty shows that they have no guidelines. Most people don't follow a proven plan, a set of strict principles, or buy and sell rules to correctly guide them. 19. Not looking at stocks objectively. Many pick favorites and cross their fingers. Instead of relying on hope and their own opinions, successful investors pay attention to the market, which is usually right. How many of these describe your own past investment beliefs and practices? Poor principles and methods yield poor results. Sound principles and methods yield sound results. After all of this, don't feel discouraged. Just remember what Rockne would say: build up your weaknesses until they become your strong points. It takes time and a little effort to get it right, but in the end, it's worth every minute. Chapter 9. When to sell and cut your losses. Now that you've learned how and when to buy nothing but the best stocks, it's time to learn how and when to sell them. You've probably heard the sports cliché, the best offense is a strong defense. The funny thing about clichés is they are usually true. A team that's all offense and no defense seldom wins the game. In fact, a strong defense can often propel a team to great heights. During the glory days of President and General Manager Branch Rickey, the Brooklyn Dodgers typically had good pitching. In the game of baseball, the combination of pitching and fielding represents the defensive side of a team and probably 70% of the game. It's almost impossible to win without them. The same holds true in the stock market. Unless you have a strong defense to protect yourself against large losses, you absolutely can't win big in the game of investing. Bernard Baruch, a famous market operator on Wall Street and trusted advisor to U.S. presidents, said it best: if a speculator is correct half of the time, he is hitting a good average. Even being right 3 or 4 times out of 10 should yield a person a fortune if he has the sense to cut his losses quickly on the ventures where he has been wrong. As you can see, even the most successful investors make mistakes. These poor decisions will lead to losses, some of which can become quite awful if you're not disciplined and careful. No matter how smart you are, how high your IQ or education, how good your information, or how sound your analysis, you're simply just not going to be right all the time. In fact, you'll probably be right less than half the time. You positively must understand and accept that rule number 1 for the highly successful individual investor is always cut short and limit every loss. To do this takes discipline and courage. Baruch's point was driven home to me with an account I managed back in 1962. The general market had taken a 29% nosedive, and we were right on only one of every 3 commitments we had made in this account. Yet the account was ahead at the end of the year. The reason was that the average profit on the 33% correct decisions was more than twice the average of small losses we took when we were off target. The whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. You've got to recognize when you may be wrong and sell without hesitation to cut short every one of your losses. How can you tell when you may be wrong? That's easy. The price of the stock will drop below the price you paid for it. Each point your favorite brainchild falls below your cost increases both the chance you're wrong as well as the price you're going to pay for being wrong. When you say, "I can't sell my stock because I don't want to take a loss," you assume that what you want has some bearing on the situation. But the stock doesn't know who you are, and it couldn't care less what you hope or want. Besides, selling doesn't give you the loss. You already have the loss. If you think a loss isn't incurred until you sell the stock, you're kidding yourself. The larger the paper loss, the more real it will become. For example, if you paid $40 per share for 100 shares of Can't Miss Chemical, and it's now worth $28 per share, you have $2,800 worth of stock that cost you $4,000. You have a $1,200 loss. Whether you convert the stock to cash or hold it, it's still worth only $2,800. Even though you didn't sell, you took your loss as the stock dropped in price. You'd be better off selling and going back to a cash position where you can think far more objectively. When you're holding on to a big loss, you are rarely able to think straight. You rationalize and say it can't go any lower. However, keep in mind that there are many other stocks to choose from where your chance of recouping your loss could be greater. Here's another suggestion that may help you decide whether to sell. Pretend you don't own the stock and you have $2,800 in the bank. Then ask yourself, do I really want to buy this stock now? If your answer is no, then why are you holding on to it? Individual investors should definitely set firm rules, limiting the loss on initial invested capital in each stock to an absolute maximum of 7% or 8%. Because of large position size problems and broad diversification that lessens overall risk, most institutional investors do not have the flexibility to follow such a quick loss-cutting plan. It is very difficult for institutions to move quickly in and out of stocks, which is necessary in order for them to follow this loss-cutting rule. This is a terrific advantage you, the individual investor, have over the institutions, so use it. When the late Gerald M. Loeb of E.F. Hutton was writing his last book on the stock market, I had the pleasure of discussing this idea with him. In his first work, The Battle for Investment Survival, Loeb advocated cutting all losses at 10%. I was curious and asked him if he always followed the 10% loss policy himself. "I would hope," he replied, "to be out long before they ever reach 10%. Loeb made millions in the market. Bill Astrop, president of Astrop Advisory Corporation in Atlanta, Georgia, suggests a minor revision of the 10% loss-cutting plan. He thinks individual investors should sell half of their position in a stock if it is down 5% from their cost, and the other half once it's down 10%. This is sound advice. To preserve your hard-earned money, I think a 7% or 8% loss should be the limit. The average of all your losses should be less, perhaps 5% or 6%, if you're strictly disciplined and fast on your feet. If you can keep the average of all your mistakes and losses to 5% or 6%, you'll be like the football team that opponents can never move the ball on. If you don't give up many first downs, how can they ever beat you? Now here's a giant secret. If you use charts to time your buys precisely at correct buy or pivot points, coming off of sound chart bases, price consolidation areas, your stocks will rarely ever drop 8% from a correct buy point. This is a big key for your future success. Also, there's no rule that says you have to wait until every single loss reaches 7% to 8% before you take it. On occasion, you will sense that the general market index is under distribution, selling, or that your stock isn't acting right, and that you are starting off amiss. In such cases, you can cut your losses sooner, when a stock may be down only 1 or 2 points. Before the market broke wide open, in October 1987, for example, there was ample time to sell and cut losses short. That correction actually began on August 26th. If you are foolish enough to try bucking the market by buying stocks during a bear market, I would move up your absolute loss-cutting point to 3% or 4%. After years of experience, your average losses should become less as your stock selection and timing improve, and you learn to make small follow-up buys in your best stocks. It takes a lot of time to learn to safely make follow-up buys when a stock is up, but this method of money management forces you to move your money from slower-performing stocks into your stronger ones. You'll end up selling stocks that are not yet down 7% or 8% because you are raising money to add to your best winners during clearly strong bull markets. Remember, 7% to 8% is your absolute loss limit. You must sell without hesitation. No waiting a few days to see what might happen or hoping the stock rallies back. No need to wait for the day's market close. Nothing but the fact you're down 7% or 8% should have a bearing on the situation at this point. Once you're ahead and have a good profit, you can afford to give the stock a good bit more than 7% or 8% room for normal fluctuations in price. Do not sell a stock just because it's off 7% to 8% from its peak price. It's important that you understand the difference. In one case, you are probably starting off wrong. The stock is not acting the way you expected, and you are beginning to lose your own hard-earned money, and may be about to lose a lot more. In the other case, you have begun right. The stock has acted better and you have a gain. You are working on a profit, so you can afford to give the stock more room to fluctuate, and avoid getting shaken out on a normal 10% to 15% correction. The key is timing your stock purchases exactly at breakout points to minimize the chance that a stock will drop 8%. All common stocks are speculative and risky. There is considerable risk in all common stocks, regardless of their name, quality, purported blue-chip status, previous performance record, or current good earnings. Keep in mind that most growth stocks top when their earnings are excellent and analysts' estimates are still rosy. Every 50% loss began as a 10% or 20% loss. Having the raw courage to sell and cheerfully take your loss is the only way you can protect yourself against the possibility of much greater losses. Decision and action should be instantaneous and simultaneous. To be a big winner, you have to learn to make decisions. I've known at least a dozen educated and otherwise intelligent people who were completely wiped out solely because they would not sell and cut a loss. What should you do if a stock gets away from you and the loss becomes greater than 10%, which can happen to anyone? This is an even more critical sign that the stock positively must be sold. The stock was in more trouble than normal, so it fell further and faster than normal. Many new investors in the year 2000 lost heavily, and some were wiped out, lost it all. If they had just followed the simple sell rule discussed above, they would have protected most of their capital. In my experience, those that get away from you for larger-than-normal losses are the truly awful selections that absolutely must be sold. Something is really going wrong with the stock or the whole market, and it's even more urgent that this stock be sold to avoid a later catastrophe. Remind yourself, if I ever let a stock drop 50%, I must make 100% gain on the next stock just to break even. And how often do I buy stocks that double? You cannot afford to sit with a stock where the loss keeps getting worse. It is a dangerous fallacy to assume that because a stock goes down, it has to come back up. Many don't. Others take years to recover. AT&T hit a high of $75 in 1964 and took 20 years to come back. Also, when the S&P 500 or Dow declines 20% to 25% in a bear market, many stocks will plummet 60% to 75%. The only way to prevent these types of bad losses is to cut them without hesitation while they're still small. Always protect your account so you can live to invest successfully another day. In 2000, many new investors incorrectly believed all you had to do was buy high-tech stocks on every dip in price because they would always go back up and there was easy money to be made. This is the amateur's strategy, and it almost always leads to heavy losses. You must remember, semiconductors and other technology stocks are 2 to 3 times as volatile and risky as others. So moving rapidly to cut short every loss is even more essential when you're in tech stocks. If your entire portfolio is in nothing but high-tech stocks, or if you're heavily margined in tech stocks, you are asking for serious trouble if you don't quickly cut your losses. You should never invest on margin unless you're willing to cut short all of your losses. You could go belly up in no time. If you happen to get a margin call from your broker, when you're faced with a decision to either sell stock or add money to your account to cover lost equity in a falling stock, don't put good money after bad. Sell some stock and recognize what the market and your margin clerk are trying to tell you. There's an old investment saying that the first loss in the market is the smallest loss. In my view, the way to make investment decisions is to always, no exceptions, take your losses quickly and your profits slowly. Yet most investors get emotionally confused and take their profits quickly and their losses slowly. What is your real risk in any stock you buy under the method we've discussed? It's 8%, no matter what you buy, if you religiously follow this rule. Still, most investors stubbornly ask, shouldn't we sit with stocks rather than selling and taking a loss? How about unusual situations where some bad news suddenly hits and causes price declines? Does this loss-cutting procedure apply all the time, or are there exceptions, like when a company has a good new product? The answer: there are no exceptions. It doesn't change the situation one bit. You must always protect your hard-earned pool of capital. Letting your losses run is the most serious mistake made by almost all investors. You must accept the fact that mistakes in stock selection and timing are going to be made frequently, even by the most experienced of professional investors. I'd go so far as to say that if you aren't willing to cut short and limit your losses, you probably shouldn't buy stocks. Would you drive your car down the street without brakes? If you were a fighter pilot, would you go into battle without a parachute? One of the most unprofessional things a stockbroker can do is hesitate or fail to call customers whose stocks are down in price. That's when the customer needs help the most. Shirking this duty in difficult periods shows a lack of courage under pressure. About the only thing that's worse is for brokers to take themselves off the hook by advising customers to average down, buy more of a stock that already shows a loss. If I were advised to do this, I'd close my account and look for a smarter broker. Everyone loves to buy stocks. No one loves to sell them. As long as you hold a stock, you still have hope it might come back up enough to at least get you out even. Once you sell, you abandon all hope and accept the cold reality of temporary defeat. Investors are always hoping rather than being realistic. The fact that you want a stock to go up so you can at least get out even has nothing to do with the action and brutal reality of the market. The market obeys only the law of supply and demand. A great trader once noted that there are only 2 emotions in the market, hope and fear. The only problem, he added, is we hope when we should fear, and we fear when we should hope. Many years ago, I heard a story by Fred C. Kelly, the author of Why You Win or Lose, which illustrates perfectly how the conventional investor thinks when the time comes to make a selling decision. A little boy was walking down the road when he came upon an old man trying to catch wild turkeys. The man had a turkey trap, a crude device consisting of a big box with the door hinged at the top. The door was kept open by a prop, to which was tied a piece of twine leading back 100 feet or more to the operator. A thin trail of corn scattered along a path lured turkeys to the box. Once inside, the turkeys found an even more plentiful supply of corn. When enough turkeys had wandered inside the box, the old man would jerk away the prop and let the door fall shut. Having once shut the door, he couldn't open it again without going up to the box, and this would scare away any turkeys lurking outside. The time to pull away the prop was when as many turkeys were inside as one could reasonably expect. One day, he had 12 turkeys in his box. Then one sauntered out, leaving 11. "Gosh, I wish I had pulled the string when all 12 were there," said the old man. "I'll wait a minute, and maybe the other one will go back." While he waited for the 12th turkey to return, 2 more walked out on him. "I should have been satisfied with 11, the trapper said. "Just as soon as I get one more back, I'll pull the string." 3 more walked out, and still the man waited. Having once had 12 turkeys, he disliked going home with less than 8. He couldn't give up the idea that some of the original turkeys would return. When finally only 1 turkey was left in the trap, he said, "I'll wait until he walks out or another goes in, and then I'll quit." The solitary turkey went to join the others, and the man returned empty-handed. The psychology of the normal investor is not much different. They hope more turkeys will return to the box, when they should fear that all will walk out, and they'll be left with nothing. If you're a typical investor, you probably keep records of your transactions. When you think about selling a stock, you probably look at your records to see what price you paid for it. If you have a profit, you may sell, but if you have a loss, you tend to wait. After all, you didn't invest in the market to lose money. However, what you should be doing is selling your worst-performing stock first. Keep your flower patch free of weeds. You may decide to sell your shares in Home Depot, for example, because they show a nice profit, but you'll keep your Kmart because it still has a ways to go before it's back to the price you paid. If this is the way you think, you're suffering from the price-paid bias that afflicts 95% of all investors. Suppose you bought a stock 2 years ago at $30, and it's now worth $34. Most investors would sell it because they have a profit. But what does the price paid 2 years ago have to do with its worth now? What does that have to do with whether the stock should be held or sold? The key is the relative performance of this stock versus others you either own or could potentially own. To help avoid the price-paid bias, particularly if you're a longer-term investor, I suggest you use a different method of analyzing results. At the end of each month or quarter, compute the percentage change in price of each stock from the last date you did this type of analysis. Now, list your investments in order of their relative price performance since your previous evaluation period. Let's say your Caterpillar is down 6%, your ExxonMobil is unchanged, and General Electric is up 10%. Your list would start with GE on top, then ExxonMobil, then Caterpillar. At the end of the next month or quarter, do the same thing. After a few reviews, you will easily recognize the stocks that are not doing well. They'll be at the bottom of the list. Those that did best will be at or near the top. This method isn't foolproof, but it does force you to focus your attention not on what you paid for stocks, but on the relative performance of your investments in the market. It will help you maintain a clearer perspective. Of course, you have to keep records of your costs for tax reasons, but you should use this more realistic method in the longer-term management of your portfolio. Doing this more often than once a quarter can only help you. Eliminating the price-paid bias can be profitable and rewarding. Anytime a commitment in a security is made, you should also determine the potential profit and the possible loss. This is only logical. You wouldn't buy a stock if there were a potential profit of 20% and a potential loss of 80%, would you? But how do you know this is not the situation when you buy a stock if you do not attempt to define these factors and operate according to well-thought-out selling rules? Do you have specific selling rules you've written down and follow, or are you flying blindly? I suggest you write down the price at which you expect to sell if you have a loss, 8% or less below your purchase price, as well as the expected profit potential of all the securities you purchase. For instance, you might consider selling your growth stock when its P/E ratio increases 130% or more, from the time the stock originally began its big move out of its initial base pattern. By writing it down, it will be easier to see when the stock has reached one of these levels. It's bad business to base your sell decisions on your cost and hold stocks that are down in price simply because you can't accept the fact that you made an imprudent selection and lost money. In fact, you're making the exact opposite decisions from those you would make if you were running your own business. It's also risky, and possibly foolish, to say to yourself, I'm not worried about my stocks being down because they are good stocks and I'm still getting my dividends. Good stocks bought at the wrong time can go down as much as poor stocks, and it's possible they might not be such good stocks in the first place. It may just be your personal opinion that they're good. Furthermore, if a stock is down 35% in value, isn't it rather absurd to say you're all right because you are getting a 4% dividend yield? A 35% loss plus a 4% income gain equals a whopping 31% net loss. To be a successful investor, you must face facts and stop rationalizing and hoping. No one emotionally wants to take losses, but to increase your chances of success in the stock market, you have to do many things you don't want to do. Develop precise rules and hard-nosed selling disciplines, and you'll gain a major advantage. Chapter 10. When to Sell and Take Your Profit. This is one of the most vital chapters in this book, covering an essential subject few investors handle well, so study it carefully. Common stock is just like any merchandise. You, as the merchant, must sell your stock if you're to realize a profit, and the best way to sell a stock is when it's on the way up, while it's still advancing and looking strong to everyone else. This way, you won't get caught in the heart-rending 20% to 40% corrections that can hit market leaders and put downside pressure on your portfolio. You'll never sell at the exact top, so don't kick yourself if a stock goes still higher after you sell. If you don't sell early, you'll be late. The object is to make and take significant gains, and not get excited, optimistic, or greedy as a stock's advance gets stronger. Keep in mind the old saying, bulls make money and bears make money, but pigs get slaughtered. The basic objective of every account should be to show a net profit. To retain worthwhile profits, you must sell and take them. The key is knowing when to do just that. Bernard Baruch, the financier who built a fortune in the stock market, said, "Repeatedly I have sold a stock while it was still rising, and that has been one reason why I have held on to my fortune. Many a time I might have made a good deal more by holding a stock, but I would also have been caught in the fall when the price of the stock collapsed." When asked if there was a technique for making money on the stock exchange, Nathan Rothschild, the highly successful international banker, said, "There certainly is. I never buy at the bottom, and I always sell too soon." "Only a fool holds out for the top dollar," said Joe Kennedy, one-time Wall Street speculator and the father of former President John F. Kennedy. "The object is to get out while a stock is up, before it has a chance to break and turn down." Gerald M. Loeb, also, states, "Once the price has risen into estimated normal or overvaluation areas, the amount held should be reduced steadily as quotations advance." One simply must get out while the getting is good. The secret is to hop off the elevator on one of the floors on the way up, and not ride it back down again. To be a big success in the stock market, you need rules and a profit and loss plan. I developed many of the buy and sell rules described in this book in the early 1960s when I was a young stockbroker with Hayden Stone. These rules helped me buy a seat on the New York Stock Exchange and start my own firm shortly thereafter. When I started out, though, I concentrated on developing a set of buy rules that would locate the very best stocks. But as you'll see, I only had half of the puzzle figured out. My buy rules were first developed in January 1960, when I analyzed the 3 best-performing mutual funds of the prior 2 years. The standout was the then small Dreyfus Fund, which racked up gains twice as large as many of its competitors. I sent away for copies of every Dreyfus quarterly report and prospectus from 1957 to 1959. Then I calculated the average cost of each new stock they purchased. Next, I got a book of stock charts and marked in red the average price that Dreyfus had paid for its new holdings each quarter. After looking at more than 100 Dreyfus purchases, I made a stunning discovery. Every stock was bought at the highest price that it had sold for in the past year. In other words, if a stock bounced from $40 to $50 for many months, Dreyfus bought as soon as it made a new high in price and traded between $50 and $51. The stocks had also formed certain chart price patterns before leaping into new high ground. This gave me two important clues. Buying on new highs was important, and certain chart patterns spelled big profit potential. Before we examine the key selling rules one by one, keep these two key points in mind. First, buying right solves most of your selling problems. If you buy exactly at the right time off a proper daily or weekly chart base in the first place, and you do not chase or pyramid a stock when it's extended in price more than 5% past a correct pivot buy point, you will be in position to sit through most normal corrections. Winning stocks very rarely ever drop 8% below a correct pivot buy point. In fact, most big winners don't close below their pivot point. Buying as close as possible to the pivot point is therefore absolutely essential and may let you cut the smaller number of resulting losses quicker than 8%. A stock might only have to drop 4% or 5% before you know something could be wrong. Second, beware of the big block selling you see on the ticker tape just after you buy a stock during a bull market. The selling might be emotional, uninformed, temporary, or not as large relative to past volume as it appears. The best stocks can have sharp sell-offs for a few days or a week. Consult a stock chart for overall perspective to avoid getting scared or shaken out in what may just be a normal pullback. By studying how the greatest stock market winners all topped, as well as the market itself, I came up with the following list of factors that occur when a stock tops and rolls over. Perhaps you noticed that few selling rules involve changes in the fundamentals of a stock. Many big investors get out of a stock before trouble appears on the income statement. If the smart money is selling, so should you. Individual investors don't stand much chance when institutions begin liquidating large positions. You buy with heavy emphasis on fundamentals such as earnings, sales, profit margins, return on equity, and new products. But many stocks peak when earnings are up 100%, and analysts are projecting continued growth and higher price targets. Therefore, you must frequently sell based on unusual market action, price and volume movement. There are many different signals to look for when trying to recognize when a stock is topping. These include the price movement surrounding climax tops, adverse volume, and other weak action. A lot of this will become clearer to you as you continue to study this information, as well as apply it to your daily decision-making. These principles have been responsible for most of my success in the market, but they can seem a bit complicated at first. Climax tops. Many leading stocks top in explosive fashion. They make climax runs, when a stock suddenly advances at a much faster rate for 1 or 2 weeks after an advance of many months. In addition, they often end in exhaustion gaps, when a stock's price opens up on a gap from the prior day's close, on heavy volume. These and related bull market climax signals are discussed in detail below. 1. Largest daily price run-up. If a stock's price is extended for many months, it's had a significant run-up from its buy point off of a sound and proper base, and closes for the day with a larger price increase than on any previous up days since the beginning of the whole move up. Watch out. This usually occurs very close to a stock's peak or top. 2. Heaviest daily volume. The ultimate top might occur on the heaviest volume day since the beginning of the advance. 3. Exhaustion gap. If a stock that has been advancing rapidly is greatly extended from its original base many months ago, and then opens on a gap up in price from the previous day's close, the advance is near its peak. For example, a 2-point gap in a stock's price would occur if it closed at its high of $50 for the day, and the next morning opened at $52 and held above $52 during the day. This is called an exhaustion gap. 4. Climax top activity. Sell if a stock's advance gets so active that it has a rapid price run-up for 2 or 3 weeks on a weekly chart, 8 to 10 days on a daily chart. This is called a climax top. The price spread from the stock's low to high for the week will be greater than on any prior week since the beginning of the original move, many months ago. In a few cases, near the top of a climax run, a stock may retrace the prior week's large price spread from the prior week's low to its high point, and close the week up a little, with volume remaining very high. I call this railroad tracks, because on a weekly chart you'll see 2 parallel vertical lines. This is a sign of continued heavy volume distribution without real additional price progress for the week. 5. Signs of distribution. After a long advance, heavy daily volume without further upside price progress signals distribution. Sell your stock before unsuspecting buyers are overwhelmed. 6. Stock splits. Sell if a stock runs up 25% to 50% for 1 or 2 weeks on a stock split. Stocks tend to top around excessive stock splits. If a stock's price is extended from its base and a stock split is announced, in many cases the stock could be sold. 7. Increase in consecutive down days. The number of consecutive down days in price versus up days in price will probably change and increase after most stocks start down from their top. You may see 4 or 5 days down, followed by 2 or 3 days up, whereas before you would have seen 4 days up and then 2 or 3 down. 8. Upper channel line. In a few cases, you should sell if a stock hits its upper channel line after a huge run-up. On a stock chart, channel lines are somewhat parallel lines drawn by connecting the lows of the price pattern with one straight line and then connecting the highs made over several months with another straight line. Studies show that stocks surging above their upper channel lines should be sold. 9. 200-day moving average line. Some stocks may be sold when they are 70% to 100% or more above their 200-day moving average price line. 10. Selling on the way down from the top. If you didn't sell early while the stock was still advancing, sell on the way down from the peak. After the first breakdown, some stocks may pull back up in price one time. Low volume and other weak action. 1. New highs on low volume. Some stocks will make new highs on lower or poor volume. As the stock goes higher, volume trends lower, suggesting that big investors have lost their appetite for the stock. 2. Close at or near day's price low. Tops can also be seen on a stock's daily chart in the form of arrows pointing down. That is, the stock will, for several days, close at or near the lows of the daily price ranges, fully retracing the day's advances. 3. Third or fourth stage bases. Sell when your stock makes a new high in price if it's off a third or fourth stage base. The third time is seldom a charm in the market. It has become too obvious, and almost everyone sees it. These late-stage base patterns will usually be faulty, appearing more wide and loose. 4. Signs of a poor rally. When you see initial heavy selling near the top, the next recovery will follow through weaker in volume, show poor price recovery, or last a shorter number of days. Sell on the second or third day of a poor rally. It may be the last good chance to sell before trend lines and support areas are broken. 5. Decline from the peak. After a stock declines 8% or so from its peak, in some cases, examination of the previous run-up, the top, and the decline may help determine if the advance may be over or if a normal 8% to 12% correction is in progress. You may occasionally want to sell if a decline from the peak exceeds 12% or 15%. 6. Poor relative strength. Poor relative price strength can be a reason for selling. Consider selling when a stock's IBD's relative price strength rating drops below 70. 7. Lone Ranger. Consider selling if there is no confirming price strength by any other important member of the same industry group. Breaking support. Breaking support occurs when stocks close the week below established major trend lines, as well as other forms of price support. 1. Long-term uptrend line is broken. Sell if a stock closes at the end of the week below a major long-term uptrend line or breaks a key price support area on overwhelming volume. An uptrend line should connect at least 3 intraday or intra-week price lows, occurring over a number of months. Trend lines drawn over too short of a time period aren't valid. 2. Greatest one-day price drop. If a stock already has made an extended advance and suddenly makes its greatest one-day price drop since the beginning of the move, consider selling if confirmed by other signals. 3. Falling price-heavy weekly volume. In some cases, sell if a stock breaks down on the largest weekly volume in its prior several years. 4. 200-day moving average line turns down. After a prolonged upswing, if a stock's 200-day moving average price line turns down, consider selling the stock. Also, sell on new highs if a stock has a weak base with much of the price work in the lower half of the base or below its 200-day moving average price line. 5. Living below 10-week moving average. Consider selling if a stock has had a long advance, then closes below its 10-week moving average, and lives for many weeks below that average, unable to rally. Other prime selling pointers. 1. If you cut all losses at 7% or 8%, take a few profits when up 25% or 30%. Compounding 3 gains like this could give you 100% or more gain. However, don't sell for 25% or 30% gains any market leader with institutional support that's up 20% in only 1, 2, or 3 weeks from the pivot buy point on a proper base. Those could be your big leaders and should be held for a potentially greater profit. 2. Big investors must sell when they have buyers to absorb their stock. Therefore, consider selling if a stock runs up and then good news or major publicity, a cover article in Business Week, for example, is released. 3. When it's exciting and obvious to everyone that a stock is going higher, sell because it's too late. Jack Dreyfus said, "Sell when there is an overabundance of optimism, when everyone is bubbling over with optimism and running around trying to get everyone else to buy. They are fully invested. At this point, all they can do is talk. They can't push the market up anymore. It takes buying power to do that." Buy when you're scared to death and others are unsure. Wait until you are happy and tickled to death to sell. 4. In most cases, sell when quarterly earnings percentage increases slow materially for 2 consecutive quarters. 5. Be careful of selling on bad news or rumors. They may be of temporary influence. Rumors are sometimes started to scare the individual investor, the little fish, out of his or her holdings. 6. Always learn from all of your past selling mistakes. Do your own post-analysis by plotting on charts your past buy and sell points. Study your mistakes carefully and write down additional rules to avoid past mistakes that caused excessive losses. Closely related to the decision on when to sell is when to sit tight. Following are some suggestions for doing just that. Buy growth stocks where you can project a potential price target based on earnings estimates for the next year or two and possible PE expansion from the stock's original base breakout. Your objective is to buy the best stock with the best earnings at exactly the right time and have the patience to hold it until you have been proven right or wrong. In a few cases, you may have to allow 13 weeks after your first purchase before you conclude that a stock that hasn't moved is a dull, faulty selection. This, of course, applies only if the stock did not reach your defensive, loss-cutting sell price first. In a fast-paced market like the one in 1999, tech stocks that didn't move after several weeks while the general market was moving higher could have been sold earlier, and the money moved into other stocks that were breaking out of sound bases with top fundamentals. When your hard-earned money is on the line, it's important more than ever to pay attention to the general market and check IBD's The Big Picture column, which analyzes the market averages. If you make new purchases when the market averages are under distribution, topping, and starting to reverse direction, you'll have trouble holding the stocks you've bought. Most breakouts will fail, and most stocks will go down. So stay in phase with the general market direction. Don't argue with a declining market. After a new purchase, draw a defensive sell line in red on a daily or weekly graph at the precise price level at which you will sell and cut your loss, 8% or less below your buy point. In the first 1.5 to 2 years of a new bull market, you may want to give stocks this much room on the downside and hold until the price touches the sell line before selling. In some instances, the sell line may be raised, but kept below the low of the first normal correction after your initial purchase. If you raise your loss-cutting sell point, don't move it up too close to the current price. This will keep you from being shaken out during any normal weakness. You definitely shouldn't continue to follow a stock up by raising stop-loss orders, because you will be forced out near the low of an inevitable natural correction. Once your stock is 15% or more above your purchase price, you can begin to concentrate on the price where or under what rules you will sell on the way up to nail down your profit. Any stock that rises close to 20% should never be allowed to drop back into the loss column. If you buy a stock at $50 and it shoots up to $60, plus 20% or more, and you don't take the profit when you have it, there's no intelligent reason to ever let it drop all the way back to $50 or below and create a loss. You may feel embarrassed, ridiculous, and not too bright buying at $50, watching it hit $60, and then selling at $50 to $51. But you've already made the mistake of not taking your profit. Avoid making a second mistake and letting it develop into a loss. Remember, one important objective is to keep all of your losses as small as possible. Also, major advances require time to complete. Don't take profits during the first 8 weeks of a move unless the stock gets into serious trouble or is having a 2 or 3 week climax run-up on a stock split. Stocks that show a 20% profit in less than 8 weeks should be held through the 8 weeks unless they are of poor quality, without institutional sponsorship or strong group action. In many cases, dramatic stocks advancing 20% or more in only 1 to 4 weeks are the most powerful stocks of all, capable of doubling, tripling, or more. If you own one of these true can-slim market leaders, try to hold it through the first couple of times it pulls back in price, to or slightly below its 10-week moving average price line. Once you have a decent profit, try to hold through the stock's first short-term correction of 10% to 20%. Remember, your objective is not just to be right, but to make big money when you are right. "It never is your thinking that makes big money," said Livermore. "It's the sitting." Investors who can be right and sit tight are rare. It takes time for a stock to make a large gain. The first 2 years of a new bull market typically provides your best and safest period, but require courage, patience, and profitable sitting. If you really know a company and its products well, you'll have the additional confidence required to sit tight through several inevitable but normal corrections. Achieving giant profits in a stock takes time and patience. Chapter 11. Should you diversify, invest for the long haul, buy on margin, sell short, etc.? When you decide to participate in the stock market, there are more decisions you are faced with besides which stock to purchase. There's the notion of how you will handle your portfolio, how many stocks you should buy, what types of actions you will take, and what types of investments are better left alone. This chapter will introduce you to the many options and alluring diversions you have at your disposal. Some are very beneficial and worthy of your attention, while many others are overly risky, complicated, or an unnecessary distraction and less rewarding pursuit. Regardless, it helps to be informed and know as much about the investing business as possible. How many times have you been told, "Don't put all your eggs in one basket"? On the surface, it seems like good advice, but my experience is that few people do more than one or two things exceedingly well. Jacks of all trades and masters of none are rarely dramatically successful in any field, including investing. Would you go to a dentist who did a little engineering or cabinet making on the side, and who on weekends wrote music and worked as an auto mechanic, plumber, and accountant? This is true of companies as well as people. The best example of diversification in the corporate world is the conglomerate. Most conglomerates don't do well. They're too big, too inefficient, and too spread out in too many businesses to focus effectively and grow profitably. Do you remember when Mobil Oil diversified into the retail business when it bought Montgomery Ward, the struggling national department store chain? It never worked. Neither did Sears Roebuck's move into financial services with the purchases of Dean Witter and Coldwell Banker, nor General Motors' takeover of computer services giant EDS, nor hundreds of other corporate diversification attempts. The more you diversify, the less you know about any one area. Many investors over-diversify. The best results are usually achieved through concentration, by putting your eggs in a few baskets you know well and watch very carefully. The more stocks you own, the slower you may be to react and take selling action to raise sufficient cash when a serious bear market begins. You should sell, get off margin, and raise at least some cash when major market tops occur. Otherwise, you will give back most of your profits. The winning investor's objective should be to have one or two big winners, rather than dozens of very small profits. It's much better to have a number of small losses and a few very big profits. Broad diversification is often a hedge for ignorance. Most people with $20,000 to $100,000 to invest should consider limiting themselves to 4 or 5 carefully chosen stocks. Once you own 5 stocks and a tempting situation comes along that you want to buy, you should muster the discipline to sell off your least attractive investment. If you have $5,000 to $20,000 to invest, 3 stocks might be a reasonable maximum. A $3,000 account could be confined to 2 equities. Keep things manageable. The more stocks you own, the harder it is to keep track of them. Even investors with portfolios over $1 million need not own more than 6 or 7 well-selected securities. How to spread your purchases over time. It's possible to spread your purchases out over a period of time. When I accumulated a position in Amgen in 1990 and 1991, I bought on numerous days. The buying was spread out, and add-on buys were only made when there was a significant gain on earlier buys. If the market price was 20 points over my average cost and a new buy point occurred off a proper base, I bought more. However, newcomers should be extremely careful in trying this more risky, highly concentrated approach. You've got to do it right, and you positively have to sell or cut back if things don't work as expected. In a bull market, one way to maneuver your portfolio toward more concentrated positions is to follow up and make one or two smaller additional buys in stocks as soon as they have advanced 2% to 3% above your original or last purchase price. However, don't allow yourself to keep chasing a stock once it's extended too far past a correct buy point. This will also spare you the frustration of owning a stock that goes a lot higher but isn't doing your portfolio much good because you own fewer shares of it than you do of other, less successful issues. At the same time, sell and eliminate stocks that start to show losses before they become big losses. Using the follow-up purchasing procedure should keep more of your money in just a few of your best stock investments. No system is perfect, but this one is more realistic than a haphazardly diversified portfolio and has a better chance of achieving important results. Diversification is definitely sound, just don't overdo it. Always set a limit on how many stocks you will own, and stick to your rules. If you do decide to concentrate, should you invest for the long haul or trade more frequently? The answer is that the holding period, long or short, is not the main issue. What's critical is buying the right stock, the very best stock, at precisely the right time, then selling it whenever the market or your various sell rules tell you it's time to sell. The time between your buy and your sell could be either short or long. Let your rules and the market decide which one it is. If you do this, some of your winners will be held for 3 months, some for 6 months, and a few for 1, 2, 3 years or more. Most of your losses will be held for shorter periods, normally from a few weeks to 3 months. No well-run portfolio should ever have losses that have been carried 6 months or more. Keep your portfolio clean and in sync with the market. Remember, good gardeners always weed the flower patch and prune weak stems. One type of investing I have always discouraged people from doing is day trading, where you buy and sell a given stock on the same day. Most investors lose money doing this. The reason is simple. You're predominantly dealing with minor daily fluctuations that are harder to read than basic trends over a longer time period. Besides, there's generally not enough profit potential in day trading to offset the commissions you generate and the losses that inevitably must occur. Don't try to make money so fast. Rome wasn't built in a day. There is a new form of day trading that is more like short-term swing trading, buying a stock on the upswing and selling before an inevitable pullback. It involves buying a stock at its exact pivot buy point off a chart, coming out of a base or price consolidation area, and selling it 5 or so days later after the breakout. Sometimes pivot points off of patterns such as the cup with handle pattern, identified on intraday charts of 5-minute intervals, can reveal a stock breaking out from an intraday pattern. If done with real skill, this can work for some people, but it requires a lot of time, study, and experience. Should you use margin? In the first year or two, while you're still learning to invest, it's much safer to operate on a cash basis. It usually takes most new investors at least 2 to 3 years to fully gain enough market experience, make several bad decisions, waste time trying to reinvent the wheel, and experiment with unsound beliefs before they are able to make and keep substantial profits. With a few years' experience, a sound plan, and a strict set of both buy and sell rules, you might consider buying on margin, using borrowed money from your brokerage firm in order to purchase more stock. Generally, margin buying should be done by younger investors who are still working. Their risk is somewhat less because they have more time to prepare for retirement. The best time to use margin is usually during the first 2 years of a new bull market. Once you recognize a new bear market, you should get off margin immediately and raise as much cash as possible. You must understand that when the general market declines and your stocks start sinking, you will lose your initial capital twice as fast if you're fully margined than you would if you were invested on a cash basis. This dictates that you absolutely must cut all losses quickly and get off margin when major general market deterioration begins. If you speculate in small capitalization or high-tech stocks, fully margined, a 50% correction can cause a total loss. This happened to some new investors in 2000 and early 2001. You don't have to be fully margined all the time. Sometimes you'll have large cash reserves and no margin. At other times, you'll be invested on a cash basis. At still other points, you'll be using a small part of your margin buying power. And in a few instances, when you're making genuine progress in a bull market, you may be fully invested on margin. All of this depends upon the current market situation and your level of experience. I have always used margin and believe it offers a real advantage to an experienced investor who knows how to confine his or her buying to quality market leaders and who has the discipline and common sense to always cut losses short, with no exceptions. Your margin interest expense, depending on laws that change constantly, might be tax-deductible. However, in certain periods, margin interest rates can become so high that the probability of substantial success may be limited. If a stock in your margin account collapses in value to a point where your stockbroker asks you to put up money or sell stock, don't put up money. Think about selling stock. 9 times out of 10, you'll be better off. The marketplace is telling you that you're on the wrong path, you're getting hurt, and things aren't working. So sell and cut back your risk level. Again, why put good money after bad? To buy on margin, you'll need to sign a margin agreement with your broker and have your stock certificates held in Street, the brokerage company's name. As long as you're dealing with an established New York Stock Exchange firm, this should not create risk for you. In fact, having stock held in Street cuts down on the time and paperwork involved in keeping up with stock certificates, dividends, and splits, and it is more common now than ever. In fact, most investors do not have their brokers issue actual stock certificates anymore. This eliminates the time and trouble of taking securities back and forth to your broker each time you make a transaction, and it averts problems and notorious delays with transfer agents, whose job it is to collect, register, transfer, and mail certificates. The itemized account statements that most brokers provide each month are enough for most investors, since they serve as complete records for tax purposes. Should you sell short? I did some research on short selling and wrote a booklet in 1976, now out of print, but not much has changed on the subject since then. It's still a topic few investors understand, and an endeavor at which even fewer succeed, so consider carefully whether it's right for you. More active and seasoned investors might consider limited short selling. However, short selling is far more complicated than simply buying stocks, and most short sellers are run in and lose money. What is short selling? Think of short selling as reversing the normal buy and sell process. In short selling, you sell the stock instead of buy it, even though you don't own it, and therefore must borrow it from your broker, in the hope that it will go down in price instead of up. If the stock falls in price as you expect, you can cover your short position by buying it in the open market at a lower price and pocket the difference as your profit. You would sell short if you think the market is going to drop substantially or that a certain stock is ready to cave in. You sell the stock first, hoping to buy it back later at a lower price. Sounds easy, right? Wrong. Short selling rarely works out well. Usually the stock you sell short, expecting a colossal price decrease, will do the unexpected and begin to creep up in price. When it goes up, you lose money. Effective short selling is usually done at the beginning of a new general market decline. This means you have to short based on the behavior of the daily market averages. This in turn requires the ability to 1. Interpret the daily Dow, S&P 500, or NASDAQ indices, and 2. Select stocks that have had tremendous run-ups and have definitely topped out months earlier. In other words, your timing has to be flawless. You can be right, but if you're too early, you can be forced to cover at a loss. In selling short, you also have to minimize your risk by cutting your losses at 8%. Otherwise, the sky's the limit, and your stock could have an unlimited price increase. My first rule in short selling: don't sell short during a bull market. Why fight the overall tide? However, sooner or later you may disregard the advice in this book, try it for yourself, and find out the hard way, the same way one learns that wet paint signs usually mean what they say. Save the short selling for bear markets. Your odds will be a little better. The second rule is, never sell short a stock with a small number of shares outstanding. It's too easy for market makers and professionals to run up a thinly capitalized stock on you. This is called a short squeeze, meaning you could find yourself with a loss and be forced to sell. And it doesn't feel very good when you're in one. It's safer to short stocks trading an average daily volume of 5 to 10 million shares or more. Typically, short selling must be executed on an uptick from the previous trade. An uptick is any trade that is higher than the previous trade by at least a penny. Therefore, orders should normally be entered either at the market or at a maximum, with a limit of 25 cents or so below the last price. A weak stock could trade down a point or more without having an uptick. One alternative would be buying put options that don't need an uptick to receive an executed trade. You could also short tracking indices, like the QQQ Nasdaq 100, SMH Semiconductor Index, or BBH Biotech Index. These also do not require an uptick. Shorting is done in a margin account, so check with your broker to see if you can borrow the stock you want to sell short. Also, if the stock pays a dividend while you are short, you'll have to pay the dividend to the person who bought the stock you sold. Lesson: don't short big dividend-paying stocks. Short selling is treacherous even for professionals, and only the more able and daring should give it a try. One last warning: don't short an advancing stock just because its price seems too high. You could be taken to the cleaners. To summarize, diversification is good, but don't over-diversify. Concentrate on a smaller list of well-selected stocks, and let the market help determine how long each should be held. Using margin may be okay if you're experienced, but it involves significant extra risk. Lastly, don't sell short unless you know exactly what you're doing. Be sure to use charts for your timing. Chapter 12. How to pick the best market sectors, industry groups, and subgroups. The majority of leading stocks are usually in leading industries. Studies show that 37% of a stock's price movement is directly tied to the performance of the industry group the stock is in. Another 12% is due to strength in its overall sector. Therefore, roughly half of a stock's move is due to the strength of its respective group. Because specific industry groups lead each market cycle, you can see how critical it is to consider a stock's industry group before making a purchase. For the purposes of this discussion, there are three terms we will use: sector, industry group, and subgroup. A sector is a broad grouping of companies and industries. These include, for example, basic industries, or cyclicals, consumer goods and services, transportation, finance, and high technology. An industry group is a smaller, more specific grouping of companies. You normally have several industry groups within one sector. A subgroup is even more specific, dividing the industry group into several very precise subcategories. For example, if we were to look at a company like Viacom, it could be described according to the following: sector, leisure and entertainment; industry group, media; subgroup, radio, TV. For clarity and ease of use, industry group and subgroup names are combined into one description and simply called industry groups. For example, the industry group for Viacom is known as Media, Radio, TV. Why does IBD divide securities into 197 industry groups, rather than the 52 groups categorized, say, by Standard & Poor's? It's simple, really. All stocks in a given sector do not perform at the same rate. Within a given sector, even if the sector itself is outperforming other sectors, there may be segments of that sector that perform extremely well, and others that lag the market. It's important to be able to recognize what's acting better since this knowledge can mean the difference between superior and mediocre results. Early on in our study of the market, we realized that many of the investment services available at the time did not adequately dissect the market into enough industry groups. It was therefore difficult to determine the specific part of a group where the true leadership was. So we created our own industry groups, breaking down the market into 197 different subcategories, and providing investors with more detailed insights into the makeup of an industry. When analyzing industries, we've found some to be so small that signs of strength in the group might not be relevant. If only 2 small, thinly traded companies make up a sector, it may not be enough to call them a group. On the other hand, there are industries with too many companies, such as the chemical and savings and loan industries. This excessive supply does not add to their attractiveness unless some extremely unusual changes occur in industry conditions. The 197 industry groups mentioned above can be found each business day in Investor's Business Daily. There we rank each group according to its 6-month price performance, so that you can easily determine which industries are the true leaders. Buyers operating on the undervalued philosophy love to do their prospecting in the worst-ranked groups, but analysis has shown that, on average, stocks in the top 50 or 100 groups perform better than those in the bottom 100. To increase your odds of finding a truly outstanding stock in an outstanding industry, concentrate on the top 40 groups. Both the newspaper and the charting services offer an additional proprietary source of information to help determine if the stock you're thinking about buying is in a top industry group. Industry Group Relative Strength Rating assigns a letter grade from A+ to E to each publicly traded company that we follow, with A+ being best. A stock with a rating of A+, A, or A- means it is in the top 24% of all industry groups in terms of price performance. Every day, I also quickly check the New Price Highs list in IBD. It is organized in order of the broad industry sectors with the most individual stocks that made new price highs the previous day. You can't find this list in other business publications. Just note the top 5 or 6 sectors. They are usually the true leaders. Another way to find out what industry groups are in or out of favor is to analyze the performance of a mutual fund family's industry funds. Fidelity Investments, one of the nation's successful mutual fund managers, has more than 35 industry mutual funds. A glance at their performance provides yet another good perspective on which industry sectors are doing better. For William O'Neill & Company institutional clients, a weekly datagraph service is provided that arranges 197 industry groups in order of their group relative price strength for the past 6 months. Stocks in the strongest categories are shown in Volume 1 of the O'Neill database books, and stocks in the weaker groups are in Volume 2. The importance of following industry trends. If economic conditions in 1970 told you to look for an improvement in housing and a big upturn in building, what stocks would have been included in your definition of the building sector? If you acquired a list of them, you'd find that there were hundreds of companies in that sector at the time. So how do you narrow down your choices to the ones that are performing best? The answer? Look at them from the industry group and subgroup levels. There were actually 10 industry groups within the building sector for investors to consider during the 1971 bull market. That meant 10 different ways you could have played the building boom. Many institutions bought stocks ranging from lumber producer Georgia-Pacific to wallboard leader U.S. Gypsum to building products giant Armstrong Corporation. You could have also gone with Masco in the plumbing group, a home builder like Kaufman & Broad, building material retailers and wholesalers like Standard Brands Paint and Scotty's Home Builders, or mortgage insurers like MGIC. Then there were manufacturers of mobile homes and other low-cost housing, suppliers of air conditioning systems, and makers and sellers of furniture and carpets. Do you know where the traditional building stocks were during 1971? They spent the year in the bottom half of all industry groups, while newer, building-related subgroups in better-performing industry groups more than tripled. On August 14, 1970, the Mobile Home Group crossed into the top 100 industry groups and stayed there until February 12, 1971. The group returned to the top 100 on May 14, 1971, and then fell into the bottom half again on July 28, 1972. In the prior cycle, mobile homes were in the top 100 groups in December 1967 and dropped to the bottom half in 1969. The price advances of mobile home stocks were spellbinding during these positive periods. From 1978 to 1981, the computer industry was one of the leading sectors. Traditionally, money managers then thought of the industry as consisting of IBM, Burroughs, Sperry Rand, and the like. But these were all large mainframe computer manufacturers, and they failed to perform during that cycle. Why? Because while the computer sector was hot, some industry groups within it, like mainframe computers, were not. Meanwhile, the computer sector's many other subdivisions performed unbelievably. During that period, you could have selected stocks from groups such as mini-computers, Prime Computer, microcomputers, Commodore International, graphics, Computer Vision, word processors, Wang Labs, peripherals, Verbatim, software, Cullinane Database, or time-sharing, Electronic Data Systems. These winners increased 5 to 10 times in price. During 1998 and 1999, the computer sector again led, with 50 to 75 computer-related stocks making Investors Business Daily's new high list almost daily. However, it was Siebel Systems, Oracle, and Veritas in the enterprise software group, and Brocade and Emulex, local network stocks, that provided leadership. The computer internet group boomed with Cisco, Juniper, and BEA systems, and EMC and Network Appliance in the memory group had enormous runs, while the former leading personal computers group lagged in 1999. After their tremendous increases, most of these leaders then topped in 2000. Many new subgroups have sprung up since then, and many more will spring up in the future as new technologies are dreamed up and applied. We are in the computer, communications, and space age. New inventions and technologies will spawn thousands of new and superior products and services. We're benefiting from an endless stream of ingenious offshoots from the original mainframe industry, and in the past they came so fast we had to more frequently update the various industry categories in our database just to keep up with it. Grouping and tracking stocks by industry group can also help get you out of weakening investments faster. If, after a successful run, one or two important stocks in a group break seriously, the weakness may sooner or later wash over into the remaining stocks in that field. For example, in February 1973, weakness in some key building stocks suggested that even stalwarts such as Kaufman & Broad and MGIC were vulnerable, despite the fact that they were holding up well. At the time, fundamental research firms were in unanimous agreement about MGIC. They were sure the mortgage insurer had earnings gains of 50% locked in for the next 2 years, and that the company would continue along its merry course unaffected by the building cycle. The analysts were wrong. MGIC later collapsed, along with the rest of the deteriorating group. In the same month, ITT traded between $50 and $60, while every other stock in the conglomerate group had been in a long decline. The two central points overlooked by 4 leading research firms that recommended ITT in 1973 were that the group was very weak, and ITT's relative strength was trending lower, even though the stock itself was not. Sometimes a major development happens in one industry, and related industries later reap follow-on benefits. For example, in the late 1960s, the airline industry underwent a renaissance with the introduction of jet airplanes, causing airline stocks to soar. The increase in air travel a few years later spilled over to the hotel industry, which was more than happy to expand to meet the rising number of travelers. Beginning in 1967, hotel stocks enjoyed a tremendous run. Loews and Hilton were especially big winners. The follow-on effect, in this case, was that increased air travel created a shortage of hotel space. When the price of oil grew dear in the late 1970s, oil companies began drilling like mad for the suddenly pricey commodity. As a result, higher oil prices fueled a surge not only in oil stocks in 1979, but also in the stocks of oil service companies that supplied the industry with exploration equipment and services. The roaring success of small and medium-sized computer manufacturers during the 1978 to 1981 bull market created follow-on demand for computer services, software, and peripheral products in the market resurgence of late 1982. As the Internet took off in the mid-1990s, people discovered an insatiable demand for faster access and greater bandwidth. Soon, networking stocks surged, with companies specializing in fiber optics enjoying massive gains in their share prices. The cousin stock theory. If a group is doing exceptionally well, there may be a supplier company, a cousin stock, that's also benefiting. As airline demand grew in the mid-1960s, Boeing was selling many new jets. Every new Boeing jet was outfitted with chemical toilets, made by a company called Monogram Industries. Amid earnings growth of 200%, Monogram stock had a 1,000% advance. In 1983, Fleetwood Enterprises, a leading manufacturer of recreational vehicles, was a big winner in the stock market. Textone was a small cousin stock that supplied vinyl-clad paneling and hollow-core cabinet doors to RV and mobile home companies. If you notice a company that's doing particularly well, research it thoroughly. In the process, you may discover a supplier company also worth investing in. Most group moves occur because of substantial changes in industry conditions. In 1953, aluminum and building stocks had a powerful bull market due to pent-up demand for housing in the aftermath of war. Wallboard was in such short supply that some builders offered new Cadillacs to gypsum board salespeople just to buy a carload of their product. In 1965, the onrush of a Vietnam War that was to cost $20 billion or more created solid demand for electronics used in military applications and defense during the war. Companies such as Fairchild Camera climbed more than 200% in price. In the 1990s, discount brokerage firms continued to gain market share versus full-service firms as investing became more and more mainstream. Charles Schwab, one of the most successful discount brokerage firms, performed as well as market leader Microsoft during this time. In our database research, we also pay attention to areas of the country where corporations are located. In our ratings of companies as far back as 1971, we assigned extra points for those headquartered in Dallas, Texas, and other key growth or technology centers, such as California's Silicon Valley. Shrewd investors should also be aware of demographic trends. From data such as the number of people in various age groups, it's possible to predict potential growth for certain industries. The surge of women into the workplace and the gush of baby boomers help explain why stocks like The Limited, Dress Barn, and other retailers of women's apparel soared between 1982 and 1986. It also pays to understand the basic nature of key industries. For example, high-tech stocks are 2.5 times as volatile as consumer stocks, so if you don't buy right, you can suffer larger losses. Or, if you concentrate most of your portfolio in them, they could all come down at the same time. So be aware of your risk exposure if you get over-concentrated in the volatile high-tech sector. It's also important for investors to know which groups are defensive in nature. If, after a couple of bull market years, you see buying in groups such as gold, silver, tobacco, food, grocery, and electric and telephone utilities, you may be approaching a top. Prolonged weakness in the utility average could also be signaling higher interest rates and a bear market ahead. The gold group moved into the top half of all 197 industries on February 22, 1973. Anyone ferreting out such information got the first crystal-clear warning at that time of one of the worst market upheavals since 1929. Of the most successful stocks from 1953 through 1993, nearly 2 out of 3 were part of group advances. So remember, the importance of staying on top of your research and being aware of new group movements cannot be overestimated. Chapter 13. How you could make $1 million owning mutual funds. A mutual fund is a diversified portfolio of stocks managed by a professional investment company, usually for a small management fee. Investors purchase shares in the fund itself and make or lose money based on the combined profits and losses of the stocks within the fund. What you're buying when you purchase a mutual fund is professional management to make decisions for you in the stock market. You should handle a mutual fund differently from the way you handle individual stocks. A stock may decline and never come back in price. That's why you always need a loss-cutting policy. In contrast, a well-selected, diversified, domestic growth stock fund run by an established management organization will, in time, always recover from the steep corrections that naturally occur during bear markets. The reason they come back is that mutual funds are broadly diversified and generally participate in each recovery cycle in the U.S. economy. Mutual funds are outstanding investment vehicles if you learn how to use them correctly. However, many investors don't understand how to manage them to their advantage. The first thing to understand is that the big money in mutual funds is made by owning them through several business cycles, market ups and downs. This means 10, 15, or 20 years or longer. To sit tight for that long requires patience and confidence. It's like real estate. If you buy a house and then get nervous, selling out after only 3 or 4 years, you may not make anything. It takes time for your property to appreciate. Here's how I believe you, as a shrewd fund investor, should plan and invest. Pick a diversified domestic growth fund that performed in the top quartile of all mutual funds over the last 3 or 5 years. It will probably have averaged an annual rate of return of about 20%. The fund should also have outperformed many other domestic growth stock funds in the latest 12 months. You'll want to consult a reliable source for this information. Many investment-related magazines survey fund performances every quarter. Your stockbroker or library should have special fund performance rating services such as Weisenberger Thompson Financial or Lipper Incorporated, so you can get an unbiased review of the fund you're interested in purchasing. Investors Business Daily also rates mutual funds based on their 36-month performance records, on a scale from A+ to E, as well as other performance percentages based on different time periods. Focus your research on mutual funds with an A+ or A performance rating in IBD. The fund you pick does not have to be in the top 3 or 4 in performance each year to give you an excellent profit over 10 to 15 years. You should also reinvest your dividends and capital gains distributions, profits derived from a mutual fund's sales of stocks and bonds, to benefit from compounding over the years. The way to make a fortune in mutual funds is through compounding. Compounding happens when your earnings themselves, the performance gains plus any dividends and reinvested capital, generate more earnings, allowing you to put ever greater sums to work. The more time that goes by, the more powerful compounding becomes. In order to get the most benefit from compounding, you'll need a carefully selected growth stock fund, and you'll need to stick with it over time. When is the best time to buy a fund? Any time is the best time. You'll never know when the perfect time is, and waiting will usually result in paying a higher price. You should focus on getting started and building capital that will compound over the years. How many funds should you own? As time passes, you may discover you'd like to develop an additional long-term program. If so, do it. In 10 or 15 years, you might have hefty amounts in 2 or even 3 funds. But don't overdo it. There's no reason to diversify broadly in mutual funds. Individuals with multi-million-dollar portfolios could spread out somewhat further, allowing them to place sums into a more diverse group of funds. If this is to be done correctly, some attempt should be made to own funds with different management styles. For example, money may be divvied up among a value-type growth fund, an aggressive growth fund, a mid- to large-cap growth fund, small-cap fund, etc. Many fund organizations, including Fidelity, Franklin Templeton, MFS Funds, Nicholas Applegate, Strong Funds, AIM, Scudder, American Century, Oppenheimer, Dreyfus, Vanguard Group, IDS Mutual, and others, offer families of funds with varied objectives. In most cases, you have the right to switch to any other fund in the family at a nominal transfer fee. These families could offer you the added flexibility of making prudent changes many years later. Don't let the market diminish your long-term resolve. Bear markets can last from 6 months to, in some rare cases, 2 years or more. If you're going to be a successful long-term investor in mutual funds, you'll need courage and perspective to live through many discouraging bear markets. Have the vision to build yourself a great long-term growth program and stick to it. Each time the economy goes into a recession, and the newspapers and TV are saying how terrible things are, consider adding to your fund when it's 30% or more off its peak. You might go so far as to borrow a little money to buy more if you feel a bear market has ended. If you're patient, the price should be up nicely in 2 or 3 years. Growth funds that invest in more aggressive stocks should go up more than the general market in bull phases, but they will also decline more in bear markets. Don't be alarmed. Instead, try to look ahead several years. Daylight follows darkness. You may think that buying mutual funds during periods like the Great Depression would be a bad idea because it would take 30 years to break even. However, on an inflation-adjusted basis, had investors bought at the top of 1929, they would have broken even in just 14 years, based on the performance of the S&P 500 and the Dow Jones Industrial Average. Had these investors bought at the top of the market in 1973, they would have broken even in just 11 years. If, in addition, they had dollar-cost averaged throughout these bad periods, meaning they had purchased additional shares as the price went down, lowering their overall cost per share, investors would have broken even in half the time. Even during the worst 2 market periods in history, growth funds did bounce back, and did so in less time than you'd expect. In other words, if you took the absolutely worst period of the 20th century, the Great Depression, and you bought at the top of the market, then dollar-cost averaged down, at worst it would have taken 7 years to break even. This is compelling evidence that dollar-cost averaging into mutual funds and holding them for the long haul is smart investing. Some may find this confusing, since we tell people never to dollar-cost average down in stocks. The difference is that a stock can go to zero, while a domestic, widely diversified, professionally managed mutual fund will find its way back when the market gets better, often tracking near the performance of benchmarks like the S&P 500 and Dow Jones Industrial Average. The super big gains from mutual funds come from compounding over a span of many years. Funds should be an investment for as long as you live. They say diamonds are forever. Well, so are your funds. So buy right and sit tight. The 5 most common mistakes mutual fund investors make. 1. Failing to sit tight for at least 10 to 15 years. 2. Worrying about a fund's management fee, turnover rate, or the dividends it pays. 3. Being affected by news in the market when you're supposed to be investing for the long term. 4. Selling out during bad markets. 5. Being impatient and losing confidence too soon. Other common mistakes. Typical investors in mutual funds tend to buy the best-performing fund after it's had a big year. What they don't realize is that history virtually dictates that the next year or two will probably show much slower results. If the economy goes into a recession, the results could be poorer still. Such conditions are usually enough to scare out those with less conviction and those who want to get rich quick. Some investors switch, usually at the wrong time, to another fund that someone convinces them is much safer or has a hotter recent performance record. Switching may be okay if you have a really bad fund or the wrong type of fund, but too much switching quickly destroys what must be a long-term commitment to the benefits of compounding. America's long-term future has always been a shrewd investment. The U.S. stock market has been growing since 1790, and the country will continue to grow in the future in spite of wars, panics, and recessions. Investing in mutual funds the right way is one way to benefit from America's growth and to secure your and your family's long-term financial future. Chapter 14. Important Guidelines to Remember. 1. Don't buy cheap stocks. Buy NASDAQ stocks mainly selling between $15 and $300 a share, and New York Stock Exchange stocks from $20 to $300 a share. Avoid the junk pile. 2. Buy growth stocks that show each of the last 3 years' annual earnings per share up at least 25%, and the next year's consensus earnings estimate up 25% or more. Most growth stocks should also have annual cash flow of 20% or more above EPS. 3. Make sure the last 2 or 3 quarters' earnings per share are up a huge amount. Look for a minimum of 25% to 30%. In bull markets, look for EPS up 40% to 500%. The higher the better. 4. See that each of the last 3 quarters' sales are accelerating in their percentage increases, or the last quarter's sales are up at least 25%. 5. Buy stocks with a return on equity of 17% or more. The best companies will show a return on equity of 25% to 50%. 6. Make sure the recent quarterly after-tax profit margins are improving and near the stock's peak after-tax margins. 7. Most stocks should be in the top 5 or 6 broad industry sectors in IBD's daily New Price Highs list, or in the top 20% of IBD's 197 industry group rankings. 8. Don't buy a stock because of its dividend or P/E ratio. Buy it because it's the number 1 company in its particular field, in terms of earnings and sales growth, ROE, profit margins, and product superiority. 9. Buy stocks with a relative price strength rating of 85 or higher in Investors Business Daily's Smart Select ratings. 10. Any size capitalization will do, but the majority of your stocks should trade an average daily volume of several 100,000 shares or more. 11. Learn to read charts and recognize proper bases and exact buy points. Use daily and weekly charts to materially improve your stock selection and timing. Buy stocks as they initially break out of sound and proper bases, with volume for the day 50% or more above normal trading volume. 12. Carefully average up, not down, and cut every single loss when it is 7% or 8% below your purchase price, with absolutely no exceptions. 13. Write out your sell rules that show when you will sell and nail down a profit in your stock. 14. Make sure your stock has at least 1 or 2 better-performing mutual funds who have bought it in the last reporting period. You want your stocks to have increasing institutional sponsorship over the last several quarters. 15. The company should have an excellent new product or service that is selling well. It should also have a big market for its product and the opportunity for repeat sales. 16. The general market should be in an uptrend and either favoring small or big-cap companies. If you don't know how to interpret the general market, read IBD's The Big Picture column every day. 17. Don't mess around with options, stocks trading in foreign markets, bonds, preferred stocks, or commodities. It doesn't pay to be a jack of all trades, or to over-diversify or over-asset allocate. Either avoid options outright or restrict them to 5% or 10% of your portfolio. 18. The stock should have ownership by top management. 19. Look for a new America entrepreneurial company, a new issue within the last 7 or 8 years, rather than laggard old America companies. 20. Forget your pride and ego. The market doesn't know or care what you think. No matter how smart you think you are, the market is always smarter. A high IQ and a master's degree are not guarantees of market success. Your ego could cost you a lot of money. Don't argue with the market, and never try to prove you're right and the market is wrong. 21. Read Investor's Corner and The Big Picture in IBD Daily. Learn how to recognize general market tops and bottoms. Read up on any company you own or plan to buy. Learn its story. 22. Watch for companies that have recently announced they are buying back 5% to 10% or more of their common stock. Find out if there is new management in the company and where it came from. 23. Don't try to buy a stock at the bottom or on the way down in price, and don't average down. If you buy at $40, don't buy more if it goes down to $35 or $30. Key reasons people miss buying big winning stocks. 1. Disbelief, fear, and lack of knowledge. Most big winners are newer companies, IPOs in the last 7 or 8 years. Everyone knows Sears and General Motors, but most people are simply unaware or unfamiliar with the hundreds of new names coming into the market every year. The new America names are the growth engine of America, creating innovative new products and services, plus most of the new technology. A chart service is one easy way to at least be aware of the basics of price, volume, sales, and earnings trends of all these younger companies. 2. PE bias. Contrary to conventional wisdom, the best stocks rarely sell at low PEs. Just like the best ball players make the highest salaries, the better companies sell at better, higher PEs. Using PEs as a selection criteria will prevent you from buying many of the best stocks. 3. Not understanding that the real leaders start their big moves by selling near or at new price highs, not near new lows or off a good amount from their highs. Investors like to buy stocks that look cheap because the stocks are lower than they were a few months ago, so they buy stocks on the way down. They think they are getting bargains. They should be buying stocks on the way up, just making new price highs as they are breaking out of a base or price consolidation area. 4. Selling too soon, either because they get shaken out or they are too quick to take a profit and psychologically having a hard time buying back the stock. They also sell too late, letting a small loss turn into a devastating one by not cutting all their losses at 8%. One final thought. You could definitely become a millionaire once you learn to save and invest properly. My parting advice: have courage, be positive, and don't ever give up. Great opportunities occur every year in America. Get prepared, study, learn, and go for them. What you'll find is that little acorns can grow into giant oaks, and that with persistence and hard work, anything is possible. You can do it, and your own determination to succeed is the most important element. We at Investors Business Daily, Investors.com, and Daily Graphs Online are here to help you every step of the way, and we look forward to hearing your success stories. Please email or write us, letting us know how you're doing with the CanSlim system. And of course, we're here to answer any questions you might have along the way. This is Chris Ryan for McGraw-Hill Audio. Thank you for listening. This audiobook is co-published by American Media International and Redwood Audiobooks, and is based upon the book entitled How to Make Money in Stocks by William J. O'Neill, copyrighted in 2002 in the name of William J. O'Neill, and copyrighted in 1995, 1991, 1988 by McGraw-Hill Incorporated, all rights reserved. Published by arrangement with the McGraw-Hill Companies Incorporated.